Good afternoon, students. This is the BoS for Success session of relevant assessment year is assessment year 23-24. So accordingly, the May 22 edition of your study material is relevant, and I hope all of you have gone through the study material very well. In addition to the study material, the statutory update, because the study material has been notifications and circulars up to 30th April 2022 are covered in the study material. Thereafter, your cutoff date for May 23 examination is 31st October 2022. So the 6 months notifications and circulars which are relevant for you are given in the statutory update that is web hosted at the BoS knowledge portal. So that is also relevant, and 50 MCQs have been web hosted, which are relevant for May 2023 examination. So these are the publications which are relevant, and of course RTP and MTP, mock test papers. Okay. Most important thing when you start with the income, when you talk about the income tax law, is the what is actually required in the intermediate, what is actually being covered. It's the computation of total income and tax liability of an individual. And that involves a series of steps. Initially, you go to determine what is your residential status. Residential status, whether you're a resident or not ordinarily resident or non-resident. Based on that, why is this important? Because based on my residential status, I will decide what is to be included in my total income. Suppose I'm a resident, then the global income is includable in my total income. Suppose I'm a non-resident, whatever income is accruing or arising outside India, which is not deemed to accrue or arise in India, that will not be includable in my total income. And then not ordinarily resident, of course, in addition to the income taxable in case of a non-resident, it will be income from a business controlled from India or profession set up in India. That's additional income which is taxable. So it's initially very much necessary to determine the residential status. For example, if I ask you a question on a person who is a non-resident, it does not expressly mention in the question it's a non-resident, but it contains some data for you to determine whether the person is a resident or non-resident and all. And without doing that, you proceed to the next step, computation of heads of income. You just skip that step because you think that anyway, all the information is given. From those information, I'll proceed to compute. Okay, and then this is one of the case scenarios which has come in the past. The house property, which was mentioned in the question, is a property which is located outside India. Okay, so when it's located outside India, in the case of a non-resident, it is not forming part of your total income at all. In the first place, it's not forming. So there's no benefit of giving the benefit of self-occupation in case of a self-occupied. It won't even be counted as a number for determining the self-occupied property and all that. And if it's let out also, that income will not be taxable unless it is received in India. Okay, if you earned the income outside India, if it's deposited in a bank account there, then it won't become taxable. It won't be taxable. So it's very important at the first. But suppose you don't go and determine the residential status, you straight away start solving the problem. Everything will end up being wrong. So it's determining the residential status is the first step, and it's a very important step. Thereafter, then you have to find out all the income which is taxable under the provisions of the Act has to be divided into 5 heads. Salaries, income from house property, profits and gains of business and profession, capital gains, and income from other sources. Income from other sources is the residuary head. If the income is taxable as per the provisions of the Act, it's not falling under the earlier 4 heads, it will fall under income from other sources. Because some income has been specified under this head also, like dividend income is there, family pension is there, gifts are there. So some income has been specified, but even otherwise, whatever other income is taxable, but which doesn't fall within the first 4 heads will fall under the residuary head, income from other sources. After that, what do? You apply once you compute this, then you apply the clubbing provisions. Clubbing provisions are when I have to include the income of a minor child, when I have to include the income of the spouse in my income. Act contains provisions because, if I try to avoid tax by transferring some portion of some asset to my minor child or transferring some income to my spouse or minor child, in order to prevent that kind of tax avoidance, there are certain clubbing provisions which are incorporated by means by which those income are included in the income of the individual. You do that. Thereafter, you have to do the set off carry forward provisions. You might have a loss under one head, profit under one head. Then in the normal course, interhead is permissible, but there are exceptions that we'll take up when we come to the respective chapter. Then you might have some brought forward losses. You give effect to all that. Then what you get is the gross total income. Thereafter, there are deductions from the gross total income. There are various deductions which are provided. Deduction for which you make investments, you put in LIC, you put in PPF, you get ATC deduction. Medical insurance premium, you pay, then you get ATD deduction. But everywhere there are conditions to be satisfied. The mode of payment also matters. Cash payment is not permissible for ATD deduction. Then again, for donations, also deductions are there. There are many categories in which then you have deductions in respect of certain income, but there are also only certain things are covered within the scope of your intermediate syllabus. Like ATJJ is covered. That's a very important section. Once you provide for all these deductions, thereafter, what the final result, what you get is the total income. And it is on this total income that you apply the rates of tax. Rates of tax which are provided, that you apply on this total income, and then you compute the tax liability. After you compute the tax liability, if the question asks for tax liability, you can stop with that. But if the question asks for tax payable, then you have to deduct advance tax, TDS, TCS, all those things. That we will deal with it in the course of our session. Then finally, what you will arrive is the tax payable. So this is the overview which I'm giving. So what point I'm trying to drive at is, don't leave out any chapter, because ultimately, if you say I'm going to find this particular head of income very difficult, capital gains is very difficult, I'm going to leave it out. Don't do that, because it's not only your capital gains question which will be affected, but also your total income question.
Income, the tax liability. Everything will go. So you can't at intermediate level, you can't skip any chapters or anything. Clubbing, deduction, set off, everything is very important, because your first question is on full-fledged question is on computation of total income or tax liability. Without knowing any particular head, if there's a single adjustment of loss, brought forward loss, or some loss is there in one head, and you have not gone through the provisions of set off and carry forward of losses, then definitely you will not able to solve that adjustment, and it leads to any mistakes. And after that, your gross total income, tax liability, tax payable, everything will go wrong. So it's very important that don't leave any chapter or don't leave any topic for that.
Yeah, and also whatever you study now in intermediate forms the base for your final examinations. So make sure that you read everything thoroughly. And intermediate, the subject is very, very interesting. It's full of computations. It's full of application of different rates and all. The subject is actually very, very interesting. You must take that much interest in the study material. We've given it in very simple form with the help of every chapter has a chapter overview in the beginning. Let us recapitulate in the end, where we comprehensively try to cover the provisions there. And in between also the chapters, there are many charts, diagrams to make you understand easily. But of course, you must go through it. I mean, you cannot skip the study material at all. There is no way in which you should do that, because, it's a very scoring paper. If it's 60, you can, with good preparation, you can get 55 easily. So, but children tend to find income tax difficult because probably they leave some chapters, or apparently the first time you read it, you might find a little bit difficult. But once you read it again, the things become easier for you, because at the first time you're reading it for the first time. Earlier you've not read income tax anywhere, you've not done it in your 11th standard, 12th standard. The very first time when you open it will be something very new. Whereas accounts, you would have read it in your 11th and 12th, so it doesn't seem so difficult because you already read it once. But since you're reading this subject for the first time, maybe at the first instance it might appear to be difficult, but it is not difficult. When you do the study material, everything is so well given. There are so many illustrations, examples, test your knowledge questions, that when you solve all those things, you will get a good grasp. Yeah, but you need to devote adequate time for this particular subject, and definitely it will produce the results. You can score easily 55. 55, I'm telling you, because some mistake you tend to make when you have to do things within the time constraint of 3 hours. You tend to make some mistakes. That is why I discounted and said 55. Otherwise, you can even score 60 on 60 at the intermediate level, isn't it?
Because it's a very scoring subject actually.
What did I tell about slabs of totally?
Okay. I'll just start with the slab rate for individual. At this stage of time, because only 1 month is left, so I hope that every student has gone through the study material, have done their. It's time to their self practice only. It's time for practice. I don't think so that any student is starting the income tax paper just now, because only 1 month is left for the examinations. So I'm just brief you about the slab rate for individuals. Which for the individuals who are not opting for the Section 115 BAC. Section 115 BAC is the concessional regime. I'll go into that in the next slide. Regarding the slab rate up to 2,50,000, if the individual is below 60 years, then if the income is up to 2,50,000, there will be no tax liability. The tax will be nil. In case of senior citizens means an individual who is a resident in India and who is 60 years or above but less than 80 years. In that case, your basic exemption limit will be percent, and 10 above 10 it's 30%. But in case of a super senior citizen up to 5, there is no tax. So it means if there's a super senior citizen, then in that case only the slab rate will come up to 20 or 30. There is no slab for 5% in case of super senior citizen. Now I come to this Section 115 BAC. It's a concessional design. It's an optional design ki whether an individual or HUF wants to opt for this concessional design. Kindly note that the firstly it's 12,500, then 25,000, then 37,500, then 50,000, and then 2,500, and so on. But it's regarding the normal income. In respect of your special rates of income, like suppose you have LTCG under Section 112, or LTCG taxable under Section 112A, or short-term capital gain under Section 111A. In that case, the slab rate will not be applicable. The special rate, which is under that section, that is applicable. It means 10%, 15%, 20% under 112, 111A, 112A, that will be applicable in the concessional regime also. So in this case, whether the individual is a senior citizen or super senior citizen, the slab will be the same. There is no higher basic exemption limit for the senior citizen or super senior citizen. So it's a very important point while you compare. If suppose a question is the full-fledged question and nothing is mentioned whether the individual is opting for the BAC or not, then you have to compute his tax liability as per both the provision, as per the normal provision of the Act and as per section BAC 115 BAC, and you have to advise what should the individual should do, whether it's he should opt for the 115 BAC or not, by comparing their tax liability. In that case, it is a very crucial point ki if the suppose it's a senior citizen, then you have to take care of the basic exemption limit, which is 2 lakh, 3 lakh or 5 lakh in normal provision, while it's 2,50,000 in the section 115 BAC. While opting for the section 115 BAC, there are certain deduction or exemption which are not allowed. What are those deduction or exemption? In case of salary, if the income is taxable under the head salary, then leave travel concession is not allowed under section 115 BAC. HRA allowances we will discuss later on while discussing salary also. Then exemption in respect of special allowances, daily allowances, exemption minor child when income of minor child is clubbed in the hands of parents, then there is the exemption of up to 1,500 is allowed under section 1032, which is not available in case of you are opting for 115 BAC. So 10AA, that's if you have established any unit in SCZ, then you are eligible for the deduction under section 10AA. That is also not available in respect if you are opting for 115 BAC. Similarly, deduction under section 16 in respect of salary, like your standard deduction, professional tax, and entertainment allowance. Most important is that interest on loan in respect of self-occupied property. In respect of self-occupied property, you are eligible for the interest deduction under section 24B up to 30,000 in case of it is for repair, and up to 2 lakh in case of construction or acquisition. But you are not eligible. You are not eligible for this interest deduction if you are opting for concessional regime under section 115 BAC. Then additional depreciation, deduction in respect of contribution, and like so on, where there are many deduction which you are not available, which are not available under section 115 BAC. Deduction, that chapter 6 deduction, only two deduction, that is 80 CCD2 and 80 JJAA. That is only allowed under section 115 BAC. All the other deduction, 80C, 80 CCD1, 1B, 80D, 80 TTA, TTB, nothing is allowed while you are opting for this concessional regime. So it is very important to compare both the scheme, which is more beneficial for the assessee.
Just see the requirement of the question. If the requirement specifically says ignore provisions of 115 BAC, he does not opt for 115 BAC, then you need not do it. Or if it says he opts for 115 BAC, then you should do only that. But when it says both, I mean, when it's silent, it simply requires computation of tax liability. That is the case. You have to do both.
Losses. Normally, losses are allowed to be set off inter-sources and inter-head. But in case you are opting for 115 BAC, the loss under the head house property, you can't set it off from the other heads of income. In normal scenario, in normal provisions of the Act, up to 2 lakh loss under the head house property up to 2 lakh, you can set it off against the other heads of income. But in this case, if you are opting for 115 BAC, you can't set it off the loss under the head house property from any other heads of income. So this is also a major important point to keep in mind. And it's 115 BAC, it's a concession, it's a one-time option for the individual HUF who are in the business or profession. But in case of other individuals, like suppose the salaried person, then he has an option to choose every year which scheme is more beneficial for him, normal provision or as per section 115 BAC. And in case of individual and HUF, they are exercising this option, then AM also exempt from the alternate minimum tax provision under section 115 GC. Basically, alternate minimum tax comes into picture when you have 10AA deduction, 80 JJAA, I'm talking about intermediate level. There are other deduction or profit link deduction also, but as far as intermediate level, only the relevant section I am discussing. 80 RRB, 80 QQB,
35.
and 35 AD. If you have these 5 deductions, then only alter minimum tax comes into a picture. We will discuss in later that what is alter minimum tax and how you compute that. But if that deduction came, just it should be strike in your mind that you have to compute altered minimum tax. And while you comparing both the scheme, then this is also a major point that in normal scenario, as per the normal provisions of the act, you have to compare your tax liability as per AMT also. But if the individual is opting for 115 BSE, then he is not liable for the AMT.
Some questions we can take up, like I hope it's clear now, audio, video. Jyoti, just tell us, is it clear now? Then step marking and paper 4, yeah, you have step marking. So make sure you present all your steps for all the descriptive questions, and this thing, step marking is very much there. Then how to present the answer? Just go through the suggested answers which is web hosted. Suggested answers, how we give it to you in the RTP, that will tell you the manner in which to present this thing. Study material we've dealt with and so many this ones. But one thing which I would like to tell you is, sometimes in the study material we might have given the notes separately, like when you proceed to do a computational problem, like suppose you say profits and gains of business and profession, it is. So you start from net profit, you do some additions and all, then you have to give, suppose I do a 40A 1A disallowance, add it back, then I have to give a reason for that, why I'm adding the amount back. So I can mention it there only. You need not go separately, leave some space, then start note. You don't know where your problem is going to end. It may take more space, less space. So then and there you can write the reasoning. Reasoning is very important. It can be brief. And section numbers, if you quote, it will add value to your answer. Like, it will give a very good impression that the person knows what it is in the first instance itself. So if you're sure about the section, write it. But if you're not sure, don't make a guess for the section. So, and then you can do the presentation then and there. I suppose basically presentation, you're asking for the big questions, that you can write the reasoning immediately after the adjustment in a bracket.
And in the study material and suggested, the reasoning is very in detail, because that is for your understanding. So you are not supposed to write so much in detail in the examination, because you have limited time. So the brief reasoning and just to point, what is the correct reasoning, that is required.
Now that you told about the time, let me tell them something about the time management also. See, totally the papers for 3 hours, where you have the DT section for 60 marks, the IDT section for 40 marks. Okay, so if you do the proportion, it comes to 108 minutes for direct taxes in income tax. So 108 minutes may you have MCQs, you have descriptive questions also. MCQs, you should not take more than 25 minutes. 25 minutes. Okay, then, and each descriptive, you have 3 descriptive, 3 into 14 question, 3 into 14 marks question. For each descriptive question, not more than 25 marks. Only then you will be able to complete it within the given time. 25 marks for 114 marks question. Then suppose you end up taking, instead of 25, 35 marks, the remaining time for the other 2 questions will be reduced. This is, I'm presuming, the equal distribution of time between income tax and indirect taxes. Suppose you're able to complete that faster and give this more time, then it's a different issue altogether. But ideally what you should do, I'm telling, that is 25 minutes for MCQs for income tax. I'm talking simply about income tax, 25 minutes, because you have one case scenario based MCQ, and one case scenario and MCQs based on that case scenario, and the others are individual MCQs. So, and since you don't need to actually give the reasoning for that, you should be able to complete that within 25 minutes, even if you go through it carefully and do all that. And then remaining each 25 minutes for each question, and do it in a very reasonable pace. Don't hurry up and make calculation mistakes and all, because you never know, you may not have the time to revisit it again. So be sure about the calculations, check that at every point of time so that you don't make mistakes. You're sure about what you have done and proceed that further. So time management and 15 minutes reading time also, make good use of it. Read all the questions, just see the order in which you should answer the questions. Always answer the questions you know best first. and then thereafter answer it in the order in which you are more comfortable with. Okay, but once you take up any particular question, once you've chosen a particular question, answer all the subparts one after the other. That subparts all should be at the same place. Okay, so this is what I wanted to tell relating to time management. Then negative marking, no, there's no negative marking for MCQs. Now, can we attempt all 6 questions? I heard that. No, I would advise you don't do that because as it is, there's a shortage of time. And if you try to attempt all the 6 questions, invariably you will end up going wrong. I suppose you're telling including indirect taxes. Only then it becomes so many.
But Abhay, if you attempt all the 6 marks, and in that case, obviously your last question will be left unanswered because there will be no permutation or combination of best of 5 question that will take by the examiner. That best of 5 question which you have answered more, that will be taken. So I don't think so it's a good idea because of time point of view also, and because it's not justifiable, because in each and every case it's not possible to.
Your time will be perfect for answering the questions you are required to do. That itself, it's you will have exactly the time what is required for that. So you won't have time to answer
extra question.
And if you're trying to do that, that means you're doing the other questions in a hurry, which is not at all advisable. Okay. Now let me go to residential status. As I told you earlier, residential status is most important.
Anish, can we interchange sub question in main question?
Meaning?
I guess you are asking about if the question have 2 or 3 parts, then definitely, and another question also have 2 or 3 parts, then you can't interchange that. You have to choose one question itself. If suppose question number 2 has 3 parts and question number 3 has 2 parts, then you can't do that A and B part of question number 2 and C part of question number 3 you can do. You can't do that.
I hope that is your query. Or are you asking within that subpath, can you do C first and then afterwards A and then B? Just clarify that to us, then we can proceed to answer that question. Now, coming to residential status of an individual, as I said, that is a starting point and it's very important for determination of total income. And if nothing is mentioned in your question, suppose they don't mention anything at all, they have not given any clue about the number of days present or anything, then in the normal course, if information is not contained, you assume it's a resident and ordinarily resident and proceed to answer the question accordingly. Because by and large, that's what you'll be getting at your intermediate level, but you will also be getting, you may also get questions on other residential status. But I'm telling you, as such, if nothing is mentioned, no information for computing residential status is also given, then you presume it's a resident and proceed to answer the question. Okay. Now, for resident, now the relevant sections here are 6.1. 6.1 is the relevant section for residential status of an individual. So it is based on the number of days of stay of an individual in India. So there are 2 conditions. One is if the individual is present in for 182 days or more in the relevant previous year, then he becomes a resident. Okay, if he is not present for 182 days, then if he is present for 60 days in the relevant previous year, that is in our case, it is previous year 2022-23. 2022-23. If he is present for 60 days in this year and the earlier 4 years, you see the earlier 4 previous years, 21, 22, 20, 21, 19, 20, 18, 19, he should be there for more than 365 days in India. If either of the conditions are satisfied, either 182 days or 60 plus 365 days, then he would be treated as a resident in India. But there are some exceptions. What are the exceptions? One is an Indian citizen leaving India in the relevant previous year for employment or as a member of a crew of an Indian ship. Suppose I'm leaving for the purpose of employment or member of a crew of an Indian ship, then I will be treated as a resident only if I fulfill the first condition. 182 days condition is only applicable. If I'm staying for 181 days also, then I will be a non-resident in such a case. Second, first I talked about an Indian citizen leaving India in the relevant previous year for the purpose of employment or member of crew. Second is an Indian citizen or a person of Indian origin who resides outside India, visiting India during the relevant, visiting. He's not returning permanently. He's simply visiting India during the relevant previous year and having total income, excluding income from foreign sources, less than 15 lakh. Okay, here you're talking about an Indian citizen or a person of Indian origin. Person of Indian origin is a person who he or his parents or his grandparents were born in undivided India. So even though he might be a citizen of US or something, if he's a person of Indian origin, then also this condition is applicable to him. And then having total income excluding income from foreign sources. Now, what is this total income excluding income from foreign sources? I have to take all my Indian income into consideration. Plus, I have to take into consideration income from a business controlled from India or profession set up in India. These I have to consider. Income which is accruing or rising outside India, which is not deemed to accrue or rise in India, I should not consider for this purpose. That income, so in my Indian income plus my income from business controlled from or profession set up in India, the sum total of the two, if it is lesser than or equal to 15 lakh, then again, only the first condition will apply. That is, I have to remain in India for 182 days to be treated as a resident. Otherwise, I will be a non-resident. Now, suppose the income is greater than 15 lakh. In such a case, what happens? Such a case, either I should have stayed in India for 182 days, or instead of 60 plus 365 days, the condition of 120 plus 365 days will apply in such a case. So whom am I talking about now? I am talking about an Indian citizen or a person of Indian origin residing outside India, visiting India during the relevant previous year 22-23, having total income, excluding income from foreign sources greater than 15 lakh. That is excluding income from, that is my Indian income plus my income from business controlled from a profession set up in India. That is greater than 15 lakh. Then I have to see 182 days, and if 182 days is not satisfied, then I have to see 120 days has he stayed. If 120 alone on a standalone basis is not relevant. 120 days in the current year plus 365 days in the immediately four preceding years. Then he would be treated as a resident. Okay. Then in all other cases, it will be 182 days or 60 plus 365 days in the immediately four preceding years. Okay. Now, this is as far as resident is concerned. Now, let me come to deemed resident. Who is a deemed resident? Now, all this while, my number of days of stay in India was very important, whether it's 182 days or 60 days or 365 days in the previous year, 120 days, so many days. Deemed resident is a person who is basically, he's not a resident as per 6.1. That's why he comes into 6.1a provision. Only if he is a non-resident as per 6.1, you will come into deemed resident provision as per 6.1a. It's an Indian citizen. Here, there's no person of Indian origin. He's an Indian citizen whose total income, excluding income from foreign sources, again, Indian income plus income from business controlled from a profession set up in India, is greater than 15 lakh and is not liable to tax in any other country. He should not be liable to tax in any other country. Then he would be deemed resident in India. Now, as I said, there are three residential status for an individual. One is ROR, one is RNOR, and others non-resident. Non-resident, you all know now. If these conditions are not satisfied, then they become non-resident. But within a resident, there's a resident and ordinarily resident, resident and not ordinarily resident. Let us see about that. There also the scope of income is different because the income from a business controlled from a profession set up in India plus income, Indian income is taxable in the hands of an RNOR, whereas global income is taxable in case of an ROR. Okay. Now, for ROR, RNOR status, what do we see? Additional conditions are greater than or equal to 730 days in the 7 immediately preceding previous years. He should have stayed in. And resident for 2 or more years out of 10 immediately preceding previous year. Stay in India for 730 days in the 7 immediately preceding previous years. 730 days or more. And resident for 2 years or more out of the 10 immediately preceding years. 2 out of 10 in the immediately preceding years. 2 or more years. Now, if both conditions are satisfied, if both the stay for 730 days plus resident for 2 years or more conditions are satisfied, then the person is an ROR, resident and ordinarily resident, his global income is taxable. Otherwise, he's a resident and not ordinarily resident. Otherwise, that means if one of the conditions is satisfied or none of the conditions are satisfied, he becomes a resident and ordinarily resident. Okay, this is in the general cases, but what about special cases? A person who is deemed resident by virtue of 6(1)(a), he will always be RNOR. There's no need to see fulfillment of additional conditions for a deemed resident. He is always an RNOR. That is, only in addition to the income which is Indian income, what would be taxable in his hands is an income from a business controlled from India or profession set up in India. That is for a deemed resident. The income which accrues or arises outside India, which is not deemed to accrue or arise in India, will not be taxable in his hands. Likewise, a person who becomes a resident by virtue of satisfaction of the second condition, that is, Indian citizen or a person residing outside India who comes on a visit to India, having total income excluding income from foreign sources greater than 15 lakh. In his case, he doesn't satisfy 182 days condition. His stay in India is less than 182 days, but it's more than 120 days. And in the earlier 4 years, he stayed in India for 365 days. Then that person also, by default, he will become a resident and not ordinarily resident. So by default, in two cases. One is this case, 120 plus 365 days condition, the person who satisfies that and becomes a resident. And second one, in the case of a deemed resident, he will always be resident but not ordinarily resident. But in all other cases, these additional conditions, on the basis of these stay in India, additional conditions, they would be treated as ROR and RNOR. If both the additional conditions are satisfied, then resident and ordinarily resident. If either one of the conditions are satisfied or none of the conditions are satisfied, then it's a RNOR, resident but not ordinarily resident. Now, we see the scope of total income. As I said, why is all this important? Why are we going through the whole exercise of saying what the residential status is? See, what is the scope of income which is includable? What all income I'll be including while computing the total income of a person? In case of, let's take an income received or deemed to be received in India during the previous year, then it's taxable in all three cases: ROR, RNOR, non-resident. Then income accruing or arising or deemed to accrue or arise in India during the previous year, that is also taxable in all three cases. Then income accruing or arising outside India during the previous year. See, outside India, it is always taxable in the case of an ROR. Even if such income is not received or brought into India in the previous year, it is taxable. In case of a non-resident, it is not taxable. No. In case of a resident but not ordinarily taxable, yes, but only if such income is from a business controlled in or profession set up in India. Only in such a case, it will be taxable in the hands of a not ordinarily resident. Any income which accrues or arises outside India, only in this case. In all other cases, it will be no. So it's basically, for this purpose, we do the entire exercise of determining the residential status. Can we interchange sub-questions? First C, then A, then D, like this? You can do it, but try to avoid it. Try to do it in that particular order itself. Actually, it is okay. It's okay, but it's not a most desirable presentation.
If you can leave the space for the
that would be better.
And then continue.
Who is this? Satya Lakshmi. In exam, calculate heads of income or total income. Some item are needed to prepare working note. In that pro forma mentioned, working note number to relate item after complete the pro forma. Working note show in the exam sequence wise or to any order can be, because some working notes are shown. See, as I told you, if you are preparing working notes, once you finish all the working notes, then number it, then give the reference. That would be easier, because you don't know in the beginning itself how much working notes are required. Working notes itself, also if you want, you can put it in that respective space, unless of course it's going to be very huge, like HRA working note, for instance. Like the least of the three items are exempt, then that you carry it to the next column, then the remainder you carry it to the last column. You can do it in that computation sheet itself, without showing it separately as a working note also. It'll be easier for you in the examination conditions to turn the paper again, go to the next page, write the working note, then come back. You might end up copying the wrong figure also. Sometimes, if the working note is done there itself, it will be easier for you. I think that is more preferable. It will help you to save time also and effort. isn't it?
Yes, ma'am. It's better to do in that computational format itself.
Sure, I hope residential status you are clear with. Any doubts relating to residential status?
We can take one MCQ, ma'am, also for that.
Okay.
It's better if
Okay. Okay. Now, Mr. Sushant is a person of Indian origin residing in Canada. He's a person of Indian origin residing in Canada. During the previous year 22-23, he visited India on several occasions and his period of stay in total amounted to 129 days during the previous year 22-23. And his period of stay in India during the previous year 21-22, 20-21, 19-20, 18-19 was 135 days, 115 days, 95 days, 125 days respectively. Okay, so he's a person of Indian origin. He's visiting India, and current year he stayed in 129 days, which is less than 182 days. First condition, he is not satisfying. Second condition is what? This is the modified second condition. 120 days in the current previous year plus 365 days in the 4 immediately preceding years when my total income is greater than 15 lakh, excluding income from foreign sources. Okay. Now, 120 days he is satisfying. 365, it's 135 plus 115 plus 95 plus 125. 470 days. This is 470 days. So it's greater than 365 days. So this 120 plus 365 days conditions is satisfying. Now we have to see whether his income is greater than 15 lakh. Okay. Now, only then that 120 condition will apply. If your income is not greater than 15 lakh, then you have to satisfy only the 182 condition. If you go to the, that is in a different document. Take care. See, if you see the diagram, see, only if the income is greater than 15 lakh, then both the conditions would be relevant. 182 or 120 plus 365. If the income is lesser than 15 lakh, then only 182 days conditions has to be satisfied. Income received or deemed to be received in India? Yeah, it's an Indian income. You have to consider it. 2,50,000 we have to consider for determining 15 lakh. Income accruing or arising or which is deemed to accrue or arise in India, 3,75,000 we'll have to consider. Income accruing or arising and received outside India from a business controlled from India. Yes, we have to consider this because it's from a business controlled from India. For that 15 lakh limit, we have to consider this. Income accruing or arising and received outside India from a business controlled outside India. So receipt is also outside India, business is also outside India. This we should not consider for the 15 lakh limit. So 2 lakh 50 plus 3 lakh 75 plus 5 lakh 50,000. This is 5, 7 plus 5, 12 plus 5, 17, carry 1, 6 plus 11 lakh 75,000. So this is the total income excluding income from foreign sources. This is less than 15 lakh. So what is he? It's less than 15 lakh.
So if we go back
for him, for this purpose, then I have to see only
the 182
days condition. I need not see the 120 days plus 365 days condition for this particular question. It's not relevant because his total income excluding the income from foreign sources is less than 15 lakh. So 182 days is he there? He is not there. He is there only for 129 days during the current previous year. So he becomes a non-resident. Now what is my question? Question asks me, what is the residential status? Residential status, we know he is a non-resident. Okay? How many options are there with non-resident? There are 2 options with non-resident. Okay. 2 options. Then we have to see the second part of the question, and is income liable to tax in India during the assessment year 23-24. Is it 6,25,000 or it's 11 lakh? We just now determined 11,75,000. But in case of a non-resident, now we've determined that 11 lakh, we added 5,50,000 to determine whether that limit of 15 lakh is being complied with. Now that limit has not been, that condition is not satisfied, now he has become a non-resident. Non-resident ke liye, and even if it is derived from a business controlled from India, it won't be taxable in his hands. Only These two income will be taxable in the hands of a non-resident. Income deemed to be received in India or income accruing or rising in India. So it will be 6 lakh 2 lakh 50 plus 3 lakh 75, 6 lakh 25,000. A is the correct option in this case. I hope you've understood why 11 lakh 75,000 was the figure to be considered for computing 15 lakh. Suppose the figures, let me just take that the computation resulted in a total of 16 lakh 25,000. Then this person would have become a resident because his if it's above 15 lakh, then the 120 plus 365 conditions would have applied to him. He would have become a resident. Once he becomes a resident, then by default he's a resident but not ordinarily resident. Then you have to take the business controlled from India. Then the figure would have been 16 lakh 25,000. Here also for determining that limit also, and for determining his total income liable to tax also. But once the person becomes a non-resident, then we have to exclude the income from business control from or profession set up in India. Thereafter, you arrive at the total income. I hope this is clear. Is it clear? Piyush, Anish, Dinesh, Satyalakshmi. Is it clear to all of you? Okay. Now we'll proceed to the heads of income.
Now, in the heads of income, the first...
One more thing. Sorry, Dimple.
Yeah, sure.
Actually, one thing which I wanted to tell you in this same context, which... when you're doing the various provisions of the Act, you will know that what are some benefits are not available to a non-resident. That is the higher basic exemption for a senior citizen, 3 lakh and 5 lakh, that is not available to a non-resident. Rebate under 87A, up to 12,500, that is also not available in case of a non-resident. Deduction under 80 TTB is a higher deduction of 50,000 for interest on savings account than even FD account and all. There again, that is available only to a resident, not to a non-resident. Then non-resident cannot avail of presumptive tax provisions under 44 AD and ADA. There's no restriction in 44 AE though. AE they can avail of, but AD and ADA they can't avail. And they will not be eligible for higher deduction of 50,000 under 80D. They will be eligible only for 25,000. Then benefit of exhausting unexhausted basic exemption limit for computing capital gains tax under 111A, 112 and 112A. That also will not be available to a non-resident. And when you're computing problems relating to non-residents, what you have to keep in mind is the initial receipt matters. Suppose a person is a non-resident and he's received some income outside India. It's deposited in his bank account outside India. Okay, but subsequently it's remitted to India. Subsequent remittance doesn't mean receipt. It does not tantamount to receipt. Receipt at the first instance is what matters to be taken. If it's received, deposited in the bank account outside India at the first instance, then that means it's not received in India, even if it's subsequently remitted to India.
Yes, Anish, 80 TTA is available for non-resident individual also. Because 80 TTP there is a restriction that is for senior citizen, and for the senior citizen, the individual should be resident and 60 years or above. So if the individual is not non-resident, then he is not called as a senior citizen as per the income tax law provision. But 80 TTA mein that condition of resident or non-resident is not there. Now we start with the salary. Salary, the 5 heads of income and the first head of income. While computing the, while answering the question, the full-fledged question, keep in mind that these 5 heads of income, you do the adjustment or the computation in the sequence only. Don't do that ki first you compute income from house property, then other sources or PGBP. It should be in the sequence. First head is salary, then income from house property, then profits and gains from business or profession, then capital gains and income from other sources. You can leave the space if you see that there are some salary adjustment or there are some PGBP adjustment. You can leave the space, but don't do the interchange or change the sequence. It is not advisable. So in the salary, if anything which is you receive from employer, that is taxable under the head salary. For that any income to chargeable under the head salary, it is very important that there should be an employer-employee relationship. If there is no employer-employee relationship, then it will not be taxable under the head salary. Like suppose in case of a partners of a firm. then in that case the relationship between the partners and the firm is not a employer-employee relationship, because they are the partner in the firm, they are the you can say the owner or the that is there, so they are not the employee of the firm. So in that case, the salary, interest, or whatever the profit, whatever they are receiving from the firm, that is taxable under the head PGBP, under business or profession, not in salary. Similar, next is members of parliament. If suppose they are member of parliament, MP, MLA, they are receiving some allowances from the parliament, then they are also no employer or employee relationship. So in that case, whatever they are receiving allowances, that will be taxable in under income from, under the head income from other sources, because there is no employee-employer relationship. Salary is taxable under the this head on due or received, whichever is earlier basis. If suppose you have received some salary in advance, that is taxable in the in the year in which you have received in advance, and you will not take into consideration the next year when the salary is actually needs to be due. Similarly, suppose there is a salary and there is a arrear in salary that is paid, but that arrear is already taxable in the previous year, so you are not supposed to tax in the year in which the arrear is received. So in the first place, the salary is received on the due or receipt, whichever is earlier basis. Any salary which is earned in India, that is deemed to be accrualized in India, even if they have received the salary outside India, but you have earned the salaries in India, that will be taxable in India. And even if suppose there is a you are a government employee and you have transferred to outside India, and you are a citizen of India. So whatever the services you are rendered outside India, the salary paid by the government to you would be deemed to accrualize in India, and it will be taxable in India, whether you are resident, non-resident, or RNOR. But the condition is the salary should be paid by the government and you should be a citizen of India. Then the salary will be deemed to accrualize in India. Whatever the allowances, the salary means whatever the allowances perquisite you are getting from the government, that is also taxable in India. But there is an exemption under section 10(7) in this regard. That whatever the allowances or whatever the perquisite you are getting from the government, being a citizen of India for services which you have rendered outside India, that is exempt and you are not chargeable to tax in that respect. Salary in your study material, in the salary chapter, there is a pro forma for computation of income under the head salary. This is the pro forma that in which manner you are supposed to solve the question or you are present your question, because it's a better comprehensive manner. And like already said, that whatever the exemption and you have to compute there, you can do in the computational chart your table answer itself. You are not supposed to do a working note, go on the next page and all. If the computation doesn't require so much, then you can do it in the main table itself. The salary, whichever the basic salary, whatever you receive from your employer, that is taxable. There is no exemption or nothing about it. Any fees you have received, any commission you have received, bonus, that is completely taxable. Any allowances, whatever the allowances in which exemption is available, other than that, whatever the allowances, whether it's in the form of telephone allowances, medical allowances, or any XYZ allowances, that is taxable completely. There is no exemption in this regard. Only there's a few allowances under few allowances under 1013A and under section 1014, in which regards you are getting the exemption from that allowances. Under section 1013A, it's the HRA allowances. If you are receiving HRA from your employer, then least of the following you will get the exemption. Whatever the HRA you receive, rent paid minus 10% of salary for the relevant period. Relevant period means you are not supposed to do HRA, you are receiving suppose from 1st July. So while calculating 10% of salary, you are supposed to do the 10% of salary from 1st July to 31st March only. You should not take the salary from 1st April. So keep in mind that point also for the relevant period, because the base should be the same. HRA you are receiving from 1st July, so the base should be the same, that 10% of salary for relevant period. Then the third Slab is 50% of salary if the accommodation is in Mumbai, Kolkata, Delhi and Chennai, and 40% of salary in other cities. That is also for relevant period. Relevant period means the period for which you are receiving the HRA. The least of the following will be exempt under section 1013A and the remaining is taxable under the head salary.
There is a question solely on HRA in our study material. I think you should all work out to it, na? That relevant period is, the application of relevant period is well illustrated. It's there in your study material.
Regarding the DA, there is no deduction or exemption regarding the DA. It's completely taxable. Children education allowance, you will get the exemption of rupees 100 per month per child, up to maximum of 2 children. In this case also, you have to be very careful. Suppose the question says the individual has 3 children and he is getting, suppose, children education allowances of 3,000 for each children. So then in that case, you can't give the exemption of 2,400. 2,400 means ki 100 per month is allowed for into 12 into 2. So you can't give the exemption of 2,400 in this from this 3,000 because this 3,000 he is getting for the 3 children. So it means if we compute for only 2 children, it's 2,000 only. So in the 2,000, if he is receiving for 2 children 2,000, how can you give the exemption of 2,400 in respect of that? So in that case, exemption will be 2,000 only and 1,000 will be taxable. So it's be logical in this regard. It's not like a flat rate is there of 100 per month. It's 100 per month up to what you are receiving from your employer. Similarly, in case of children hostel allowance, there is an exemption of 300 per month per child, maximum of 2 children. Transport allowance.
Anish is talking about the format given in the study material. Yeah. That's why we've given it to you so that you use that particular format.
Transport allowance, there is an exemption regarding the transport allowance, but it is only available in case of a blind, deaf and dumb and orthopedically handicapped and employee only. In that case only, the exemption of 3,200 per month is allowed. Otherwise, there is no exemption in for transport allowances for any other employee. Regarding this exemption, 1030A, suppose you are individual and you are opting for 115 BAC, then you will not get 113A exemption. You will not get children education allowances exemption. You will not get children hostel allowance exemption. But transport allowance exemption you will still get under the concession regime also. Then other allowances for which there are no exemption, like entertainment allowances, overtime allowances, city compensatory, medical allowance, telephone allowance, there is no exemption provided for that. Then you need to compute the Perquisite. There is a Perquisite valuation under Rule 3, and you have to compute the valuation of the Perquisite as per your rule. I know in the salary chapter, basically the provisions are not so vast, but the figures, but the limits you have to keep in mind. There are so much limits in this salary chapter. Is that the population is this, then the different percentage. So in the salary chapter, you have to keep in mind the limits. What are the permissible limit for exemption? What is the limit for Perquisite valuation? All these things you have to keep in mind. And illustration for every valuation, there is an illustration in the study material. Kindly go through that very carefully. And one of the important Perquisite is obligation of employer discharged by the employer. Suppose you have to do some expenses, but your employer is reimbursed you. So that the obligation, which is the obligation of yours, but it is discharged by the employer. That is your Perquisite. One of the example is that professional tax. Suppose you have to pay professional tax, but your employer has paid professional tax on your behalf, or suppose he has reimbursed you. Then in that case, that will be your Perquisite at first, and in the second you will get the deduction in this respect. We will discuss in later on this pro forma. Suppose you have some domestic servant in your house, and your employer is reimbursing for the domestic servant helper, then in that case all these things are the obligation of you, but discharged by the employer. So all are these are perquisites. Then life insurance of employee, if you have life insurance and that is payable by your employer, that also is your perquisite. Then motor car, there is a separate valuation rules for motor car. If it is completely used for official use, owned by you, and that expenses are reimbursed by the employer, or if the car is owned by the employer and you are using it for personal purpose, or partly for official purpose, or partly for personal purpose, so there is a separate valuation rules for that. Kindly go through that and go through the illustrations also. So all these are the perquisites. Any movable assets which your employer has given to you for use, yeah, or any movable asset which he has given to you for use, or he has transferred you, that in that case what will be the valuation, everything is there. Regarding LTC, there's an exemption under section 10(5) gratuity. What is the exemption which you are getting under in gratuity? If you are receiving the gratuity, if you are receiving during the tenure, during the services, then it is taxable, but at the time of retirement there is some prescribed limit, that up to that limit you will get the exemption. Similarly, for commuted pension, leave encashment, voluntary retirement compensation, for the everything there is a prescribed limit, then up to that amount you will get the exemption. Then after all these things you will get your gross salary. In that gross salary, only three type of deductions is allowed. Standard deduction, that is your amount of salary, or 50,000, whichever is less, you will get standard deduction for that. Entertainment allowances, but entertainment allowances is deduction in respect of entertainment allowances is only to the government employee. If you are not a government employee, then you will not get the exemption deduction in respect of entertainment allowances. What are the what is the deduction? That least of the following will be the reduction: 5,000, 1/5 of basic salary, or entertainment allowance which we have received. Then the next one is professional tax, or tax on employment. Whether it is paid by you or your employee, you will get the reduction of both. If you see, if professional tax is paid by the employee, then he will get the deduction here. But if the professional tax is paid by the employer, so firstly it will be your perquisite, because this is the obligation of yours which is paid by the employer, and then you will get the deduction in that respect. So firstly you will include in your salary, then you will get the deduction in this respect. Then you will get the salary which is chargeable under this head. All these three deduction you will not get when you are opting for special regime under section 115 BAC. You will not get standard deduction, you will not get entertainment allowance deduction, or you will not get professional tax deduction. So this is the difference between BAC and normal provisions of the Act.
So this salary chapter, the things to remember are more the valuation of perquisites and gratuity limits, the retirement, this thing. But these are all very important, because definitely at the intermediate level, salary question will be asked. Salary is not covered at that much at the final level. Basically the testing will all be done at the intermediate level. So even if the testing is of a higher level, it will take place only at the intermediate level. So you have to be thorough with it. It is not very difficult. Once you read it twice or thrice, then you will get a hang of it, and do all the questions. Do all the questions in the study material, the back questions at the end, in the test your knowledge, plus your RTP, MTP questions. You will get a hang of it. At least you will come to know what mistakes you're making. Once you solve it on your own, again, don't look at the answer. This is very important, very, very important part of manner of study, like you want to complete the modules very fast. Time for examination is very less. So you think, if I start doing everything, ultimately I'll make mistakes, my morale will get affected. So it's easier for me. Let me just see how it is. I'll be able to complete my studies also faster, and I can do the other subjects also. But that is actually a very bad methodology of learning, like reading the answers is very, very bad. See, in the fear of making mistakes, you should not read the answers, or in the fear of completing, or to complete the syllabus fast. Always you must put through the put yourself through the test. Like when you're doing it every day, you are ultimately testing yourself. When you're solving the question, you're testing yourself. And now if I make a mistake, now if I'm reading today, I'm making 10 mistakes. There are 10 problems. Every problem I'm making a mistake. But I'm correcting my mistakes. Now I have an opportunity today to correct myself. In the examination, I'm not going to give an opportunity to correct. Nobody is going to give you an opportunity to correct yourself. But today I solve 10 problems, I make 10 mistakes. I make one mistake in each problem, more than one mistake in each problem, but it's okay. Because by making such mistakes, I am learning where I'm going wrong and I'm correcting myself. So do all the questions on your own, even if you are making repetitive mistakes, it's okay, because once you make a mistake, once you do it, you compare your answer, you find out where you're going wrong, you learn that part, where you erred, you learn that part. Let's say that you make 10 mistakes in each chapter. There are totally around 10 chapters. 100 mistakes you'll be able to correct yourself before you go for the exam. So that is the approach which you should have. That is the right approach for studying. The people who ultimately succeed follow this approach. They do things on their own, they make mistakes, they correct themselves, and then they ensure their preparedness for the exam. So I advise that all of you should do that. Don't be scared if you make mistakes. That's a part of learning. See, if you're so perfect, then there's no need for any material, there's no need for us, there's no need for teacher, everything. Now, so all of us make mistakes. So, and we learn from our mistakes. That's how when at that point of time of the examination, then we are very well prepared so that we avoid maximum number of mistakes, which we know we are prone to make. But for that, you must put yourself through the grind. So I hope all of you follow this. This is very important, not only in tax, but I would advise in other subjects also. But in tax, most importantly, because there are lots of interpretations, the scope for making mistakes is more. You know, if you apply something wrongly, if you understood something wrongly, missed out something, it's possible. So, but go through this grind.
Puneet, I hope video is clear now, because you have returned.
Voice gone.
Voice gone.
Puneet, were you able to hear the last set of instructions which I gave you? Am I audible? Can somebody reply to this? Mahesh, Anish, Puneet. Puneet is the person who said I'm not audible. Priyanka? Is there some problem? We're not receiving any messages.
Anish, Mahesh, Puneet, anyone? Are we audible?
Yes.
Okay.
Okay.
Okay, Abhay. Thanks.
Thank you.
In this aspect, there's some common mistake or some things which you can forget in the examination. So I'm just briefing about that. Then I'll take up one MCQ, and I want participation from all of you for that MCQ also. Regarding standard deduction, because this is the standard deduction is the tendency to which we forget every time to give the standard deduction, and to know where we should give the standard deduction or not. Suppose in the question, salary of an individual is given per month, then definitely in that case it is all that salary under this head is not computed. So it means that you have to provide standard deduction separately if this individual is not opting for the 115 BAC. So in that case, you have to compute his salary, that is 30,000 into 12. Then you have to provide standard deduction of 15,000. But suppose in the question it is mentioned that the individual is getting income under the head salary computed, then it means that standard deduction effect has been already given and you are not supposed to give again the standard deduction of 50,000. But in this case, suppose the individual is opting for 115 BAC and it is given as per the normal provisions of the act, then you have to add back 50,000 if it is as per normal provisions of the act, and you have to go back again for the 115 BAC. So keep in mind this point. If it is written that Mr. A has earned this salary, so earned this salary means it is not computed. So you have to provide standard deduction. If salary is given per month, then you have to provide standard deduction. But if the word computed is already given, that you are not supposed to provide any further deduction for the salary. This is the
For that matter, for any head of income, if the word computed given, that means it's a final figure arrived at after the making the computations under that head. Income from house property computed also, you need not go again and provide the deduction. But if it's given as rental income, then you have to provide for it. So the way it's worded is very important.
Very.
Similarly, with dividend received, this again, it's a common mistake which has been happening ever since dividend has become taxable in the hands of the recipient shareholder. So dividend, if it's received, and they have not mentioned gross in the bracket. If they have mentioned gross, then please take it as gross only, even if it's written as received. But if they have not mentioned the gross, and if it's only received normally means the net amount, net after deduction of tax at source. So you must gross it up when you're taking income from other sources. When you're doing the computation of PGBP, of course, you have to deduct only what is credited to your P&L account. If the net amount is credited, you have to deduct that. But when you're taking it in other sources as the income, you have to gross it up. Received always means the net amount unless the question mentions it as gross. Dividend income is gross. If it's simply written dividend or dividend income, you can take it as gross.
Piyush is asking, standard deduction is only allowed if there is any salary income. Yeah, standard deduction in respect of salary only. And it's the amount of salary or standard deduction of 50,000, whichever is less. So there will be there can't be a loss under the head salary in any case.
See, standard deduction is otherwise a common terminology. Here, we generally use it in relation to salary income. But, like in house property also 30%, that is also standard deduction. Irrespective of the amount of what you incur, you get this much of deduction. Then it becomes a standard deduction. But in common usage, it's used in relation to salary income.
Regarding DA, if suppose in the question nothing is mentioned whether it's form parts of the retirement benefit or not, then you have to assume that it doesn't form part of the retirement benefit. Second view you also can take, but first view you can take it's not form part of retirement benefit. Gratuity, but in the gratuity case, it's a vice versa. In the gratuity, if nothing is mentioned, then you have to the first way you can take that it is payment is under the gratuity act. If nothing is mentioned in the question or nothing is there, information is there in the question. Regarding the gift voucher, suppose there is a gift voucher received of 6,000. Then in that case, because the gift voucher is exceeding 5,000, then there is a perquisite. Perquisite will be of 6,000. But as per the CBDT circular, in respect of any gift which you have received from your employer, the exemption is flat exemption of 5,000. And over above that 5,000, it will be perquisite. Then in that case, as per that CBDT circular, your 1,000 will be taxable as perquisite. So the first view, as per the plain, the first view is that 6,000 is your perquisite in case of gift voucher. But the second view is also possible that as per the CBDT circular, that the gift voucher which is received over and above 5,000 is the perquisite. So in that case, 1,000 is that. But I'm talking about the first view which you should take. That first gift voucher that above 5,000 is completely taxable. Gratuity, it's assumed that payment it's covered under Payment of Gratuity Act, and if regarding DA nothing is mentioned, that it doesn't form part of retirement benefit. Now I'm taking one MCQ. Mr. Karan completed his MBA in April 2022 and joined XYZ Limited from 1st May 2022. His basic salary is 2,25,000 per month. He is paid 12% of basic salary as DA, which is forming part of retirement benefit. He contributed 11% of his pay plus DA towards RPF, and the company contributes the same amount. Accumulated interest on Provident Fund as on 31st March 22, which means year end, is 49,325. What would be the amount chargeable under the head salary of Mr. Karan if he doesn't opt for section BAC? First basic thing that you have to take basic salary. Basic salary is 2,25,000 per month. It means 2,25,000 into 12. This is the first thing, and there is no. Then it's 27 lakh. Then DA is completely taxable. There is no exemption of DA. DA is 12% of
3,24,000.
3,24,000. 12% of basic pay. ठीक है.
From 1,500
Okay,
this thing,
sorry,
yeah? This is 11, na? 225.
Keep in mind
11.
that student that
And
he has joined on 1st May.
11, 24,75,000.
He has joined on 1st May. Then in that case, salary for 11 month only you have to
2475. 2475. And DA is 2,97,000.
DA is 12% of basic pay, so which is 2,97,000.
So it comes to 2770,000.
So it is come to, you have not supposed to do the total. I have done this because of the computation of recognized provident fund. Then I have to see the employer. If employee is contributed to recognized provident fund, then he will get the deduction under section 80C in that respect. But if your employer is contributing to the recognized provident fund, then what would you do in that case? In this case, 11% of your basic salary plus DA is contributed by your employer and by you. Employer, if employer is contributing up to 12% in the recognized provident fund, that is exempt. So if employer is contributing, suppose 13%, 14%, 15%, then up to 12% it is exempt, and over and above that is taxable. In that case, employer is contributing 11%.
So that comes to 304,920. $304,920. 11% of 27,72,000 comes to 304,920. This is the employee's contribution. Equivalent contribution of 304,920 employer is also making. Okay, fine. But the maximum which is not taxable is what? For an employer, it is only 2,50,000. So what will be the amount which is taxable? 304,920 is what the employer has contributed. 2,50,000 is the maximum which is not taxable. Beyond that, it gets taxed. Minus 2,50,000, 54,920.
So whatever the interest that employee is getting on this 54,920 is taxable. In section 10, if you see section 10, 11 and 10, 12, any payment which you get from the provident fund or that is exempt. Similarly, any accumulated balance in RPF, that would be exempt. But any interest which is accrued on the contribution made by the employee. It's not regarding the contribution made by the employer, it's the contribution regarding made by the employee. Because in the contribution made by the employer, there is a perquisite valuation of rupees 7,50,000. They have given the limit of 7,50,000. If your employer is contributing in superannuation fund or RPF or NPS, and the contribution in aggregate exceeds 7,50,000, then it is your perquisite, and the interest on that excess part is also your perquisite, and there is a separate perquisite valuation for that. But if the employee makes a contribution more than 2,50,000 in a previous year, then that interest on that contribution which is exceeding 2,50,000, it's taxable, it is not exempt. So in this case,
304,920 minus 2,50,000, 54,920. Interest accrued on 54,920 will become taxable. Here total interest is given as 49,325. This includes interest on, because the person has joined only in the current year, he's joined in May, it doesn't include any past interest. So it is only current year interest which is included. But this 49,325 interest is on total. Employer contribution of 304,920 and employee contribution of 304,920. So 304,920 into 2 will become 609,840. So 49,325 is the interest on the contribution of 609,840. So on which part of the interest will become taxable? It is 54,920. That is 304,920 interest on employee contribution minus 2,50,000 permissible limit, 54,920. So it is 54,920 divided by 609,840 into
49,325.
49,325, which is the interest. So you get 44. Let me rub it now for the time being. But anyway, we need these figures. Na? Chalo, 4442. It is coming to, sorry.
So,
4.
So that interest of 4442, it's taxable in the hands of employee. So there is no other income. So the gross salary that is taxable in the hands of Mr. Karan is
2776 442. That is 2772 we've already computed. Then this 442 is the interest accrued, which has become taxable on the excess contribution over by the employee over and above 2,50,000. So that amount of 54,920, whatever is the interest attributable to this, that is 4442. So you remember the denominator should not be 304920 denominator, because the interest is for the whole employer plus employee contribution. So 304920 is only the employee contribution. Is equivalent contribution is made by the employer. So your denominator should be 609840. So this is a common mistake which we tend to make when we are doing this particular calculation. Because you see, you compute employees contribution, you see the excess, then you do 54,920 divided by 304920, which is not correct, because that is only the employee contribution, whereas the interest of 49,325, what we are going to take into account, is for the both employer and employee contribution, though it will be equally divided.
So this is the gross salary. So don't forget to give standard deduction of 50,000, because the question asked about income chargeable under the head salary, and the person is not opting for 115 BAC. So standard deduction of 50,000 is also allowed. So in that case, your answer would
be 2776 minus 57.
27. So it will be 2726,442. So the
exam, one of the options could have been 2776,442 also. So what happens in such a case? You have made all the computations correctly. Everything would be correct. Your interest computation is also correct. But because of your standard deduction, your answer might end up being wrong in an MCQ. This is the danger of an MCQ. Because some of the most likely answers which you arrive at, like you just omitted the last one step of standard deduction here. So 2776,442, you arrived at. In the normal course, what would have happened? And if it's a descriptive question, for all your steps, you would have got your marks and all those things. For final steps, even if you make a mistake, didn't do the standard deduction, you will lose some marks. But here, your entire answer goes wrong. There's no working required, nothing is required, it's just your application. So you have to be extra careful in MCQs, because the options are so close that it is possible that you work out something, you forget one step, but still that answer is present as one of the options. Isn't it?
Yes, ma'am.
You did not give it as one of the options. Should I rub it? I'll rub it.
इनकम अंडर द हेड सैलरी में कंप्यूटेड लिखा हुआ था, इसका मतलब क्या होता है? अभिषेक, इफ इट इज रिटर्न दैट इनकम अंडर द हेड सैलरी ब्रैकेट में कंप्यूटेड, इट मींस यू आर नॉट सपोज्ड टू प्रोवाइड एनी डिडक्शन और एनीथिंग from salary. It means that salaries, that income, that whatever is income, the figure is given, that is already computed as per the provisions of the act for the under the head salary. You are not supposed to do anything, any deduction, exemption in from that figure.
Suprada, amendments here, some of the amendments will be taking up in the course of our discussion, but all the amendments, it's as such as part of your book itself, it's there. We have incorporated all the amendments in the study material itself. Statutory update, otherwise it's given. Some of them, of course, will be covering, but not all of them. We are broadly covering, trying to cover the important points under each chapter, like each of the major chapters, the important points we are trying to cover. In the course of it, some important amendments will get covered up also. Then Puneet, I have finished everything earlier, but the class is going above my head because of non-revision. Any particular reason, any particular point which we are not able to follow, Puneet? Because if you've done everything, you should be able to follow. No? Any particular thing, you please write to us, we will repeat it. You just please mention it in the chat box. We'll repeat that particular point.
Manoj has written, we should show 6,000 taxable or 1,000 taxable. Some lectures are telling full 6,000 taxable. As per the provisions of the plain reading of the act, it's 6,000 should be taxable. But because the CBDT circular gives a benefit to tax only 1,000 and it's more beneficial, so you can take that view also. But as per the provisions of the tax, the 6,000 it is taxable. So first view you should take 6,000 as taxable perquisite. Please answer which perquisite is more important. I was very confused to calculate perquisite.
All perquisites are important. All are important. Rent-free accommodation,
Motor car,
gift, movable assets,
interest on loan, everything is important. You can't leave because it can be for any adjustment can come in the examination in any way.
It is not difficult. You just have to, it's the need for more practice. I would say if you're finding it difficult because you have not practiced adequately and the provisions are a bit exhaustive as far as perquisites are concerned in salaries chapter. So because of that, you're finding it difficult. The moment you revise again, the second time you read it, you find it more easier. Then third time, if you read it, then you'll find it, yeah, I know it well. So, but yeah, you have to read it again, because once to grasp everything in one reading will be difficult. So please read it again, read it carefully, slowly. You will certainly follow it. Because actually there's nothing much of this thing, only thing that's a computation mechanism is provided there. So you have to know the manner in which you have to communicate. It's been adequately illustrated in the study material also, how you go about computing different perquisites, what's the period which you have to consider, what are the rates you have to apply, and what happens if a motor car is owned by employer, what happens, how does it the answer change if it's owned by the employee, driver, everything, so it's, you have to do all those things. It is time consuming, but not very difficult.
Puneet, normally in the question it is written ki whether DA form part of retirement benefit or not. But we are telling about the cases where it is not mentioned. Like if the individual it is not mentioned whether he is a resident or non-resident, then what you should suppose at the first instance that it should be a resident. So you can't assume it's a non-resident and solve the question. So if DA nothing is mentioned, that first view you should take that DA doesn't form part of retirement benefit. But if the other view you take, you should write clearly in your notes that you are assuming that if there is no other information from that, it can be derived whether it's part it forms part of retirement benefit or not. So you should clearly write your assumption in that particular cases.
Okay. Now we'll go to the next head of income. Okay. Now this income from house property. Normally, when you talk about income from house property, in a common this thing, you will think it's a rental income. But the Act uses the word annual value. Rental income is also one of the factors which is considered, but it's not the only factor. Other factors are also taken into account: municipal valuation, fair rent, standard rent, everything. Then it's compared with the actual rent. So it's not only the rental income; it's annual value also, which is subject to tax under income from house property. So when is it chargeable under this head? When does an income be chargeable under the head income from house property? It's this annual value of any property comprising of lands or building or land appurtenant thereto, of which the assessee is the owner. Building or land appurtenant thereto. Building or land appurtenant thereto, of which the assessee is the owner, is chargeable to tax under the head income from house property. So definitely there should be a building. Land may be appurtenant thereto, but if it's only land, then it is not chargeable under this head. If it's a vacant land, it's not chargeable under the head income from house property. Buildings or land appurtenant thereto, of which the assessee should be an owner. So suppose I myself have rented the house from somebody, and then I've sublet it to somebody else, then that subletting receipt will be taxable under income from other sources. That will not be taxable under the head income from house property. Okay, so there has to be buildings, land can be appurtenant thereto, and I should be the owner of house property. Okay, now what are the properties which are not chargeable under house property? Suppose I have a house property and I'm using it for my own business. Then the annual value of that property will not be chargeable under the head income from house property. That will be, because I'm using it for my own business or profession, the depreciation on that building will be allowable under the head profits and gains of business and profession. Also, if I am engaged in the business of letting out of house properties, suppose that is my job to let out house properties, then also my income will be chargeable under the head profits and gains of business and profession. Let me take a third case where I'm a builder, I'm a constructor, I have build a apartment consisting of 200 flats and all those things, and I sell property. Okay, then, but there is always a time gap between the time when the property is ready for construction, ready after construction, and the time in which I sell the property. So in the meanwhile, I let out some properties also. In that case, what happens? In that case, that property is my stock in trade, and my business is to sell the property. My business is not letting out of properties. My business is to sell the property, build properties, construct it and sell it. And in the meanwhile, till the time I sell the property, I'm letting it out. Or 1 or 2 flats, I keep it for letting it out. So in such a case, what happens? That income will be under the head income from house property only. That will not be chargeable under profits and gains of business or profession. I hope you've understood the difference. If I'm engaged in the business of letting out of properties, then my income will be chargeable under the head profits and gains of business and profession. If I'm a builder, if I'm holding the house property as my stock in trade and I'm letting out that property, okay, then whatever income I derive therefrom will be taxable under the head income from house property. Even if I don't let it out, I'm going to keep it self-occupied for a period of 2 years from the year of completion of construction. There is no chargeability to tax, but after that, that annual value will be chargeable, even if you don't let it out. Okay, we'll do it after this.
Uma Priya, once we completed this house property, then we will take up your query for interest calculation for the recognized provident fund. We will take it after house property.
Okay. Now, property held as stock in trade. This is what I told you. Annual value of property being held as stock in trade will be nil for a period of 2 years from the end of the financial year in which certificate of construction of the property is obtained from the competent authority. If such property is not let out during the period, if in the meanwhile, in that 2-year period, you're letting it out and getting some money, then that will become taxable. If I'm not letting it out, I'm not getting any benefit for the period of 2 years from the end of the financial year in which the certificate of completion is obtained, that till that time I'll get the benefit of nil annual value. Now, what is annual value which is chargeable to tax? See, this is the let us recapitulate, which I was telling that you have to go through that. Everything is contained in the let us recapitulate, all the major points. Okay. Now, to determine the annual value of a house property. Okay, so you compare fair rent. Fair rent is a rent which another house in the similar house in the locality fetches. Municipal valuation is as per the municipal records, whatever these two, whichever is higher. Then if it's controlled by Rent Control Act, in some areas Rent Control Act is operational, then you compare it with standard rent, and this value and standard rent, whichever is lower is the expected rent. Here it is whichever is higher, fair rent and municipal value, whichever is higher. After that, whatever value you arrive at, that and standard rent, whichever is lower is the expected rent. Now you compare the expected rent with the actual rent. If the actual rent is greater than the expected rent, then actual rent is GAV. If actual rent is lesser than the expected rent, then if it's lower because of vacancy, then the actual rent will be the GAV. Otherwise, whichever is higher is the GAV. But if it's lower because it's of vacancy, suppose you've not been able to occupy, suppose you've let out the house at 10,000 rupees per month. Your annual rent is 1,20,000. Okay? Now your 1,10,000 is your expected rent, whatever you calculate. Now the property is vacant for 2 months, because of which your actual rent becomes 1 lakh. Because of vacancy, it becomes 1 lakh. Because of vacancy, it becomes lower than the expected rent. Otherwise, actual rent was higher than the expected rent. Because of vacancy, it has become lower than the expected rent. Then the expected rent, then the rent of 1 lakh only, 1 lakh will be the gross annual value in such a case, if it's because of vacancy. If actual rent is lower than expected rent because of any other reason, then the expected rent, in that case, the normal rule will apply. Actual rent or expected rent, whichever is higher, expected rent will be the gross annual value. I hope this is very clear.
Pavan, if in the question it is not mentioned, the age of the cessee is not mentioned, then you will assume it's not a senior citizen or super senior citizen. Since they are a very special provisions, that senior citizen, super senior citizen, non-resident, the special treatment or things given. So unless otherwise it is specified in the question. Don't assume that special treatment or special provisions for any assessing.
Then in case of a self-occupied property is a property where you occupy or your family occupies. Then in such case, the benefit of annual value, you can treat it as nil. So normally, I mean, for 2 house properties, you can take the benefit of nil value. If you have 3 self-occupied properties, then one will be deemed to be let out. That also you have to do a calculation to see which is more beneficial. You have a choice. You can choose which of the 2 you wish to claim as self-occupied. Those calculations are detailed. Those are given in your study material. We can't do everything right now because we are broadly covering all the chapters. But that is very important. Up to 2 properties self-occupied, you can claim the benefit of nil value. The moment it exceeds 2, then you have to choose which of the 2 you want to keep it as self-occupied. The third one will be deemed to be let out. In case of a deemed to be let out property, since there's no actual rent, the expected rent will be the gross annual value. Okay. And in case of self-occupied property, no deduction is allowable. Otherwise, in the case of normal let-out property, you first deduct municipal taxes paid by the owner, and then you arrive at the net annual value. See, again, it should be paid by the owner. It should not be paid by the tenant. And municipal taxes due but not paid is not allowable as deduction. These are important points which you must remember while calculating income from house property, because if you do that wrong, all the other following steps will become wrong. So municipal taxes paid by the owner in the relevant previous year. Even if you're paying for past years, that also you will get it as deduction. If you're the year of payment, you will get the municipal taxes as deduction. So you get the net annual value, then 30% of net annual value is a standard deduction, and apart from that, you will get the interest deduction. These are the only 2 deductions which are permissible from income from house property. Now, as far as interest on borrowed capital is concerned, okay, in case of self-occupied property, because the annual value is nil. Annual value is nil in case of self-occupied property, so you won't get the benefit of 30% of annual value. That benefit is not available. Municipal taxes benefit is also not available. But interest from borrowed capital alone, you can claim, but the maximum allowable is 2 lakh. Okay, if the interest is for construction, acquisition of house property, but if it's for repairs and all, maximum allowable is 30,000. Okay, and then even if there are 2 self-occupied properties, 2 lakh is the consolidated total limit. Okay, whether you have 2 self-occupied properties, dono ka interest milake, you get 2 lakh. Okay, or if you have 2 house self-occupied properties, one you've taken loan for repairs, one you've taken loan for construction. Total you will get is 2 lakh. It cannot exceed 2 lakh in total. But if it's only repairs, it cannot exceed 30,000. Then what about pre-construction interest? Now, let me take a case where suppose your house property is, you've taken a loan for house property, purchasing a house property. You've taken it in, say, 2020. I've taken a loan. And then the construction is complete in 2022. 2022, June it is complete. So, but then what is the pre-construction interest? Is it up to 36, 2022? 1420 to 36, 2022? No, that is not the pre-construction interest. Though the construction is completed only on 36, 2022, that particular year, 2022-23 interest, I can claim in full. Your pre-construction interest will be up to the end of the previous year, prior to that year of completion of construction. So it will be up to 31/3/22. So 1420 to 31/3/22 will be the pre-construction interest, and current year interest I can claim in full if it's let out property, and if it's self-occupied property, that interest, current year interest plus pre-construction interest together, it has to be restricted to 2 lakh. And pre-construction interest, once I compute it, for the 2-year interest I compute, suppose I get 10 lakh as the figure, let us say 10 lakh is the pre-construction interest that is available as deduction over 5 years from the year of completion of construction. That is from the previous year 22-23, I will get 10 lakh divided by 5, 2 lakh each year in addition to that current year interest. Now my current year interest is say 3 lakh. 3 lakh is my current year interest plus this 2 lakh. 5 lakh will be my total interest which I'm eligible for. If it's a let out property, I can get it in full 5 lakh. If it's a self-occupied property, it will be restricted to 2 lakh. I hope this is clear.
Puneet is asking to explain the cutoff date to examples.
I'll just take this one in this regard. 1 minute. Where is it? Comes here. See, this is the MCQ. Mr. Vikas took a loan of 15 lakh at 10% per annum on 1/4/2020 for construction of residential house. The construction began in June 2020 and was completed on 30/6/2022. It's similar to the example I told you. He has not repaid any amount of loan so far. The amount of interest deduction under 24B for assessment year 23/24. Now, first it's for self-occupation. So with self-occupation maximum, how much is it allowed? Construction, self-occupation, maximum allowable is 2 lakh. Okay. Now we have to do what is the current year interest. See, what is pre-construction interest? When did you take the loan? You took it on 1/4/2020. Then when was the construction completed? 36/22 it was completed. But it is completed in the previous year 22/23. So the interest of the previous year 22/23 is allowable in full. This will hold good even if I'm going to complete it on say 1st of March 2023. Even then for 22/23 full year interest is allowable. Okay. What is the pre-construction interest period prior to the previous year 2022-23? So that will be 31/3/2022. So 1/4/20 to 31/3/22 is the pre-construction interest, which is for 2 years. So 2 years into 10% into 15 lakh. So 1.5 lakh into 2 will be 3 lakh. Okay. Then this is the pre-construction interest. This I have to divide in 5 equal installments. So 3 lakh divided by 5 is 60,000. 60,000 I can claim from previous year 22-23, 23-24, 24-25, 25-26 and 26-27. This is in addition to current year interest. What is my current year interest? 15 lakh into 10, 1,50,000. So I'm eligible for 1,50,000 plus 60,000. 2,10,000 I'm eligible for. Had it been let out property, I would have got full 2,10,000. But this is a self-occupied property for which the maximum deduction is 2 lakh. So the correct answer is 2 lakh. It's 2 lakh because it's self-occupied. Had it been let out, the correct answer would have been 2,10,000. I hope it is clear, Puneet. Okay. Now, some important things which I have to tell is this 2 lakh limit does not apply to let out. It does not apply to deemed let out property. I told you that if there are 3 self-occupied property, the third property will be deemed to be let out. For that, the 2 lakh limit will not apply. You can even, if it's 5 lakh also, you'll be able to get the 5 lakh. Interest is allowable on accrual basis. Interest deduction is allowable on accrual basis, not on payment basis. But if you are opting for 115 BAC, suppose you are opting for 115 BAC, then this self-occupied property deduction up to 2 lakh is not allowable. And in case of a let-out property, what happens? In case of a let-out property, what is normally the rule? My full interest is allowable as deduction. Suppose my interest is 5 lakh, it's fully allowable as a deduction. Okay, it results in a loss of say 3,50,000. Okay, I have an income of 1,50,000 against which I claim a deduction of 5 lakh. This 1,50,000 is after 30% deduction, 30% of NAV deduction. So 5 lakh, if I claim, I get the income from house property as 3 lakh, loss from house property as 3,50,000. Okay, now this loss in the normal provisions, let's forget 115 BAC for the time being. In the normal provisions itself, when I set off the loss against any other head of income, the maximum permissible set off is 2 lakh. Remaining 1,50,000, I have to carry it forward and set it off next year against my income from house property. So 2 lakh is the maximum permissible set off under the normal provisions. But if I am opting for 115 BAC, then this normal set off, though I'm allowed deduction, 5 lakh deduction I'm allowed in full. 3,50,000 is my loss, but I cannot set off any 1 rupee of loss also against any other head of income. Under the normal provisions, 2 lakh is permissible. Under 115 BAC, nothing is permissible. 3,50,000 I have to carry it forward to the subsequent year for setting off against my income from house property. Okay? Now you've understood as far as, but if it's a self-occupied property, the initial deduction of 24B under up to 2 lakh, that itself is not allowable. I hope this is clear. If it's taken before 1499, the thing is 30,000, then you won't get the benefit of 2 lakh. But nowadays, hardly the question comes for 1499. That's why I was telling you the provisions which are normally tested. And if the loan is taken prior to 1999, then even for construction or acquisition, the limit is 30,000.
Manoj, I hope whatever ma'am has said, that's clear to you. Because for pre-construction interest prior to
March, not June. Not up to June. That's what I'm telling. Current previous year, I'll be allowed in full. Previous year 22-23. Where is it? Here, na 36/2022 is the date of completion. It's not 1/4/2022 to 36/2022. No, it's 1/4/2020 to 31/3/2022. Prior to the previous year. Current year interest, the year of completion of construction, I will get the full year interest. Pre-construction is the 31st March immediately preceding that year. Because this is as far as income from house property is concerned. I hope you're clear with the carry forward and set off. A house property can be income from house, loss from house property can be carried forward for 8 years and set off against income from house property. That also, when you carry forward any income loss, then generally you are able to set it off only against the income under the same head. Exception is unabsorbed depreciation. There are some restrictions. But when we come to set off and carry forward, we will deal with that. So I hope this, in case of co-ownership, another important thing in house property is in case of co-ownership. What happened in case of co-ownership? You have to compute the house property as though it belongs to one person. Then finally, if the share is, if my share is 40%, if her share is 60%, at the last stage, after computing income from house property, we divide it 60% and 40%. However, it's a self-occupied property. This is in case of a let-out property, you do a single computation and do it. If it's in case of a let-out property, if it's in case of a self-occupied property, then what happens? The 2 lakh benefit individually is available to both of us. I can also claim a loss of up to 2 lakh and she can also claim a loss of up to 2 lakh. That is the thing of co-owned property. And this you have to keep in mind. Suppose I have a co-owned property with her and I have an individual property and both are self-occupied, then the total interest deduction which I can claim is 2 lakh. Both in respect of the co-owned property as well as in respect of the individual house property. Because I can claim self-occupation for 2 house properties which have not been let out. One can be a co-owned property, one can be an individual property, but the interest deduction will be in total 2 lakh for both.
Mahesh, in case of let-out property or deemed let-out property, in both cases, interest on loan is allowed. And there is no limit on the amount. In case of self-occupied property only, there is a limit of 30,000 or 2 lakh. But in case of let-out or deemed let-out property, there is no limit, no ceiling on the interest on loan, which is to be allowed, whether it's for repair, whether it is for purchase or construction.
There's no ceiling. As I said, after you compute the income from house property, suppose you get a loss exceeding 2 lakh. The amount of loss which you can set off against some other head of income, that is restricted to 2 lakh. I hope it is clear, Mahesh. Now that particular thing you can explain probably, that girl's question, interest before we
Uma Priya, yeah, you have asked regarding that interest computation for this example regarding the provident fund. See, in this question, what has happened? Mr. Karan has contributed 11% of his basic pay plus DA towards RPF, and the similar contribution is made by his employer, XYZ Limited. So, what is the amount of contribution? First, I have to see what is the amount of contribution Mr. Karan made and his employer. Karan's contribution. What is Karan's contribution? It is basic pay and DA ka it's 11%. So it is 304,920. Similar amount of contribution is made by his employer. So this is a trick because it's not clearly see ki what is taxable. You have to derive the value of the interest which is taxable. So as per section 1012, if you see whatever the amount that accumulated balance or become that amount becoming payable to employee participating in RPF is exempt. Whatever the amount that is due, it means whatever the interest portion you are interest we are which is accruing on the recognized provident fund is exempt. But the interest which is accrued on contribution which the employee made exceeding 2,50,000, it's not exempt, it's taxable on or after 2021. So if the employee has contributed, suppose 3 lakh, 5 lakh, then the interest which he is getting from the recognized provident fund on the portion of contribution which he made exceeding 2,50,000, it's taxable. But in this portion, it's not what is the amount of interest which is taxable. It's not clearly visible coming. So in the question, it is given that interest on this PF as on last date is 49,325. So total interest. So and the interest on the amount contributed by Mr. Karan exceeding 2,50,000 is taxable. So what is the amount which is exceeding 2,50,000? It means 54,920 is taxable. But what is the amount of interest? That is not given the question. This interest is accrued on the total balance in the recognized provident fund as on 31st March 2023. What is the balance in the recognized provident fund on this date? Karan's contribution plus employer contribution both. So it means if I have to derive that on this part, what will be the interest into the total interest which is accrued divided by a total contribution made this year. It's so which comes to 442. It means the interest which is accrued on the amount exceeding 2,50,000, which is the contribution made by the Karan, that will be taxable. That will not be exempt. So 442 is the amount taxable apart from the basic salary DA. I hope it is clear you now, Uma Priya.
Suprata, you've asked for the amendments. See, actually, if you're talking about the Finance Act amendment, it is coming along with the part of the discussions which are taking place. If you're talking about the statutory update, see, as far as the substantive provisions are concerned, the major amendment is in relation to COVID. You know, when as far as salary is concerned, it's a medical. I mean, if it's not a perquisite. When will it not be treated as a perquisite? Medical benefits are covered in section 17(2). In that particular proviso to 17(2), what are the conditions to be complied with relating to that? That is given in your statutory update. You know, it's more of a theoretical thing regarding that. And similarly, if you're talking about income from other sources, about when it will not be subject to tax under 56(2), when it's not a gift from a person, there are some conditions which are stipulated, like the certificate you have to obtain within a particular period, you have to get the benefit. And then there is a cap. If you get from the employer, there's no cap in case of a death of a person. If you get from some other person, the cap is 10 months. And what are the procedural formalities you have to comply with? That is given in your statutory update. What we are basically covering here is the points where you are likely to go wrong in the examination. Here, this is just a theoretical thing. You know, if we can divert it and go on this basis, but it will not serve the intended purpose of an overall revision. So that is why, and this part of it is mainly theoretical. When it comes to TCS, we will take up that amendment portion also. Basically, because as far as substantive law, it's only the COVID-related provisions which are coming in the stat update. Other provisions amended by the Finance Act, it's coming as part of the things which we are teaching you. Like one relating to this PF also, the calculation, that is also a recent amendment. Which one now? PGBP. Okay. Now comes profits and gains of business and profession. So profits and gains of business or profession, it's one thing which children generally tend to get scared of because there are a number of provisions, but in fact, it's one of the easiest chapters. and one of the most interesting, one of the most scoring chapters. It's definitely easier than salaries also. So definitely don't leave it out, thinking that it is difficult, because it's not at all difficult. See, basically what happens, you are given a statement of profit and loss account. Okay, from that that will form the basis of your computation of PGBP. Last time, receipts and payments accounts was given, but that also we have an illustration in our study material in computation of total income. That is a different methodology. There you take the receipts, what are taxable receipts, then deduct the allowable expenditure. Okay, that comes once in a way, but majorly what comes is the statement of profit and loss is given to you, and from that you have to derive the income. So from the statement of profit and loss, first of all, you have to add up items which are debited there, but which are not allowable as per the provisions of the Act. So depreciation as per books of account, normally you add it back. Okay, then, and you provide deduct depreciation as computed as per the Income Tax Act. That is something which you all know. In case the person is engaged in manufacturing and all those things, then you provide additional depreciation also. Then you have to see whether that 50% number of days of usage in the current previous year, then you have to restrict it to 50% or not. That is another thing you have to keep in mind. So depreciation, then income tax is not allowable. And suppose I'm deducting in April and paying in May. It's definitely before the due date of filing return, but still it's not allowable because the deduction has taken place in the next year. So you have to keep in mind, for an expenditure to be allowable as deduction in the year in which it is incurred, the tax deduction should take place in that year. It's only the remittance which can be postponed up to the due date of filing return. Then unreasonable payments to related persons, that is also disallowed. Then cash payments otherwise done by electronic modes or account pay check exceeding 10,000 to a person, that one. Debited to P&L account, of course, that is not allowable. You have to add it. Repairs of capital nature is not allowable. Then one other thing which I'd like amortization of preliminary expenditure, VRS under 35 DDA. See, like 4/5 of such expenditure, like entire expenditure, if it's been debited to P&L account, as per these sections, these kind of expenditure are allowable as a deduction over 5 years. But if my full expenditure is debited to P&L account, I have to add back 4/5. Suppose 5 lakh is debited, then I have to add back 4 lakh. Okay, but that is when the amount is debited to P&L account. Suppose it's not debited to P&L account. It is coming separately as an additional information that the amount of VRS expenditure during the year is 5 lakh. And the same has not been given effect to the P&L account. In that case, what you must do? It's not given effect to in the P&L account, so you should not add back anything. But I'm allowable. What is allowable as deduction? 1/5 of 5 lakh is allowable as deduction, so I must deduct 1 lakh. But if entire expenditure has already been debited to the P&L account, then I must add back 4 lakh. I hope this is clear. Okay, then suppose some expenditures relating to municipal taxes paid in respect of house property. And the house property is my self-occupied property. Okay, or if it's partially self-occupied, partially used for business, then you have to take out that proportion and you have to remove it. Suppose municipal taxes paid, say 10,000. Okay, if it's entirely in relation to a house property used for personal purposes, then I have to add it back because it's not related to my business. Suppose like half the property is used for my personal purposes and half it's used for my business purposes, then one half I'll have to add back. So that you have to see up according to the adjustment and facts given in the question. Then this is something which is very important. Amount paid by an assessee as an employer by way of contribution to pension scheme under Section 80 CCD exceeding 10% of the salary of the employee. 80 CCD is a pension scheme. Employer contributes to it. Up to 10% contribution he is allowed to make. If suppose the employer makes 12% contribution, then 2% should be added while computing profits and gains of business and profession. 2% because I am the employer, I am the assessee, I am the employer also. I am contributing to the employee, but instead of contributing 10%, I am contributing 12%. So the excess 2% which I contribute, that is not allowable expenditure that I have to add back. Sometimes, no, because it's an intermediate level, students get confused. Na? Like if suppose it's a normal salary question, then what happens? The employer contribution to 80 under 80 CCD will be allowed as deduction under 80 CCD too. But that is in the hands of the employee. In the hands of the employee, whatever contribution which the employer makes, first it's included in my salary income. Later on, I'm getting a deduction under 80 CCD too. But if I am the employer, then they're talking about the excess contribution which I'm making. If it's not exceeding 10% of salary, then you need not make any adjustment at all. It's allowable. If it exceeds 10% of salary, then you add back 2%. Then what is the expenditure which are allowable as deduction? So far we were talking about what are the disallowances, what are all you're adding back. But what is allowable? Depreciation which is computed as per rules. Additional depreciation at 20% on actual cost of plant and machinery. This is only in the assessee engaged in the business of manufacture or production of article or thing or distribution of power, and in such a case. Only in these cases you will be entitled for additional depreciation, not in all cases. And if the asset is put to use for less than 180 days in the year of acquisition, only 50% will be allowable. 10% only will be allowable. Balance can be claimed in the next year. Okay. So this is balance additional depreciation. Suppose some asset was acquired last year and it was put to use for less than 180 days in the earlier year. Then earlier year you would have restricted, you wouldn't have provided 20% additional depreciation, you would have provided only 10%. So the remaining 10% can be provided this year for in respect of asset acquired last year. I'm talking and put to use for less than 180 days in that year. So I hope all these are very common adjustments which repetitively keep coming in your examination. Then what else must you deduct? Because it's your statement of P&L account, it's possible that dividend income is credited to it, agricultural income is credited to it, rental income is credited. All these are not taxable under this heads. Gifts may be credited. So all those you must deduct it because they are not forming part of my profits and gains of business and profession. Rental income, that also you have to deduct. Gifts, all these things. Like dividend income, suppose they've given whatever is credited to P&L account and then they put net. Then the net amount is the one which is credited to P&L account. Okay, then that net amount is what you have to take into consideration. Net amount is what you have to deduct when you're computing profits and gains of business and profession. But when I'm taking the dividend income, it is taxable under income from other sources. There I'll have to do the grossing up. I'll have to do the grossing up at that point of time, not when I'm computing profits and gains of business and profession. Here, only whatever is credited to my P&L account, I have to deduct. If the gross amount has been credited, then you can deduct the gross amount. But generally, in the questions, they say that the net amount has been credited. Then another thing is, suppose I'm a partner of a firm. So I have my proprietary business, I'm a partner of a firm and I'm receiving salary, interest and all. As a partner, that is also chargeable to tax under the head profits and gains of business or profession. That I have to take it. Then bad debt recovered. Suppose bad debts, earlier I had my debtors was 50,000, I was allowed 30,000 deduction. Bad debts written off in the earlier year was 30,000. Now I'm recovering 25,000. So 20,000 represents the unrecovered portion. 50,000 is my total debtors. 30,000 I was allowed bad debts. 50,000 was total debtors, Mr. A's account. 50,000 was my total debtors. 30,000 bad debts, I had written it off. It was allowed as written off. Then I recovered 25,000. Now, what is the thing? What is the unwritten? What is the amount which is not written off? 20,000. So if this much amount I receive it, then there's no requirement of any tax treatment because I've not written it off in the first place. But any amount over and above 20,000 which I receive has to be my income. So 25 minus 25,000 will be my income in such a case. I hope this is clear to you. This is basic broad idea of profits and gains of business and profession. Can I proceed to presumptive tax? Or do you have some doubts in this? Any doubts? Any doubts on computation of profits and gains of business or profession? One is you've understood or you've not understood. Suprada, Umapriya, Piyus, Puneet, Manoj. Understood? Or you have facing some difficulty? Is this the one? Na? Next is coming there. No. 1 up to 37 entry. Chalo, then I take it's clear for all of you. If it's not clear, I'll repeat it once again. One other thing, family planning expenditure. Family planning expenditure is allowable as deduction only for company assessees. For an individual assessee, it's not allowable as deduction. So if that has been debited to the statement of profit and loss account, you have to add it back because it's disallowed in the case of an individual employee.
Uma Priya is asking for the bad debt concept.
Bad debts, bad debts written off in the books of accounts, it's allowable. Suppose earlier 50,000 I said is a one debt, A, Mr. A. Okay. Out of which 30,000 I've written off in my books of accounts as bad debts. 30,000 has been allowed by the assessing officer, 30,000 right off. Okay. Now I've recovered next year. This was last year. Let us say this was previous year, 21-22. Okay. Now previous year, 22-23. I recover 25,000. Okay. Now, how much will be taxable? I've recovered some money from Mr. A for 25,000. How much will be taxable? That's what we are into. So 30,000 has already been written off. Okay. So how much is still not written off? 20,000. Okay. So out of this 25,000, this 20,000 should get adjusted because for 20,000, I have not got any benefit. I have not got any benefit of deduction of bad debt with respect of 20,000. So if I'm recovering that, it's fine. There's no requirement of any treatments. But as regards the remaining 5,000, because anything over and above 20,000, I've written it off. 30,000, I've written it off as bad debts. Now I'm recovering something. So 5,000 will be towards the bad debts which I have written off. So when I'm recovering 5,000, that will be taxable as my income. Is it clear, Umapriya? 20,000 is, I have not written it off. So if I'm going to get any, recover that, there is no treatment required for that. 5,000, the amount which I recovered in excess of 20,000, 5,000 is towards the amount of 30,000 which I've already written off as bad debts. Suppose I've recovered only 15,000. Let me explain to you with another example. Suppose this is the case, 50,000 and 30,000 I've written off. I recover 15,000. Then there is no need for any treatment because 30,000 I've written off, still 20,000 is standing in my accounts, and against that I'm recovering 15,000. So there's no need for any treatment. If I receive up to 20,000, there is no need for any treatment because to that extent the amount is standing. But anything over and above 20,000, suppose the moment I receive 21,000, so that extra 1,000 is the amount which I've already written off. So that will be treated as my bad debts recovered and it will be taxable. Please explain. Yeah, you will get step marks. Manoj, admissible and inadmissible deduction. One thing, what you are telling, I'm getting your point, because see, what was given is your statement of P&L account. Okay. And whatever is admissible, whatever is debited to your P&L account, expenditure with salary expenditure is debited, administration expenditure is given there. Whatever expenditure is given, all those have already been deducted. And finally, you get the net profit. After deduction of all these amounts, you get the net profit. Let's take one question. And we don't have it in this chapter, no? We have it in the computation of total income chapter. Here.
Computation. Receipt and payment is needed.
Computation of total income. Where is that? We'll have to open that this one.
You can't use money.
We can't use this one, is it? Okay. Okay.
Question 6.
This is receipts and payment. See, Miss Purvi, I hope you are able to see the screen. Okay, is a chartered accountant in practice. She maintains her accounts on cash basis and her expenditure and income and all that. So what is the figure which we are going to take? We are going to take this net profit. See, this one won't work here, but the net profit of 928 to 24 will be taken as a starting point in our calculations, and we will be adding whatever is not to be allowed, because whatever is allowable already it's been provided. Of course, if something is given in the additional information that something has not been given effect to, then I have to further deduct it. But whatever is already debited to my P&L account is the amount which has already been considered. So if something is not to be allowed in such a case, I'll have to add it back. Like if you see this 928 224 is my starting point. Municipal tax paid in respect of house property, I'll have to add it back because that is from the computation of my income from house property. I hope this, in this case, it's fully for this particular purpose. PGVP, na? Municipal taxes, I'm adding back. See, 3,000 I'm adding back because it's been debited to P&L account. I had reduced the municipal taxes to arrive at my net profit. So I have to add it up. So whatever is inadmissible, I have to add it back, but which has been debited to P&L account. Any inadmissible item, whether any amount on which tax has not been deducted at source, capital expenditure, personal expenditure, like that. Anything which have been paid in cash in excess of 10,000 and which has been debited to P&L account. So that is not admissible. So I have to add those sums back. Then in credited to P&L account, rent received from residential flat is taxable under the head income from house property. So I'll have to reduce that 85,600 while computing, because right now I'm computing profits and gains of business and profession. This amount will be considered in my income from house property. Honorarium received from various institutions for valuation of answer papers. This is income from other sources. Income from UTI, gross amount has been credited here. So you take this amount you deduct this amount here, you take that amount as it is in the income from other sources because it's written as gross. Fee earned is, of course, it is this income. It is PGBP. Dividend on shares, again, it's a gross income 10,524. So you deduct it here and you take it under income from other sources. If it is net, then you have to deduct this amount, gross it up and take it up from income from other sources. This is the way you have to do. Whatever is allowable already debited to P&L account, no treatment. Allowable but not debited to P&L account, then you have to reduce. Like depreciation from income tax rules. That is allowable. but it has not been debited to P&L account. What has been debited to P&L account will normally be depreciation on as per the depreciation computed as per books of accounts. In this case, that also is not there. So in this case, I'll compute depreciation and allow that amount of depreciation. And see, value of benefits received from clients during the course of profession is 10,500. This is taxable under the head profits and gains of business or profession, but it's not being taken into consideration because it's not appearing in the P&L account. It's appearing in additional information. So I have to add this back. Okay. So this is the way I do it. I hope it is clear. Manoj, is it clear? I think now we'll continue with the next one.
You want to take presenting?
Okay. Okay, just do that. Yes, I think we'll have to go back to that screen. Manoj, I hope it is clear. I've not got a reply from you. Okay. Now we come to presumptive taxation. All what we dealt with earlier was as per books of accounts, where we take the net profit as the base, then you make additions, then for disallowances, and then you make deductions for other income credited and all. But when you compute on presumptive basis, then it's a flat rate, which you apply on your gross receipts or turnover. So 44 AD, who are all eligible for, there are 3 presumptive tax provisions as far as your syllabus is concerned. One is 44 AD, 44 ADA, and 44 AE. 44 AD is all resident individual HUF partnership firm, but not LLP. Here also it's the same thing, resident individual partnership firm, but not LLP. Here it is business, here it is profession. Profession specified in 44A1. 44 ADA talks about legal, medical, engineering, architectural profession. So that is not eligible for 44 AD, but that's eligible for 44 ADA. Okay. And additional conditions here is no, he is not claimed deduction under section 10A or chapter 6A deductions under C deduction in respect of certain income. 80 IA, IB, 80 JJ, those deductions should not have been claimed. Okay. So this is basically the thing, other detailed conditions you read it. But here the turnover limit is 200 lakhs for 44 AD, 50 lakhs for 44 ADA. And presumptive income is 8% of total turnover, sales, or gross receipts, or a sum higher than the said sum claimed to have been earned. 6% of total. There are 2 rates specified. 6% is where, in respect of those receipts you've received by account pay check, account pay draft, or any other electronic mode during the previous year, or on or before the due date for filing return of income. And 8% is for all other receipts, what you've not received by electronic modes and what is due but not received, and all those things, it will be 8%, and this will be 6%. But that is the minimum amount. You can claim a higher amount. In case you want to claim lower amount, then there are some conditions attached to it. In 44 ADA, again, it's 50% of gross receipts of profession or some higher. 50%, 50 lakhs, and 50 lakhs is the threshold, and 50% of gross receipts is under 44 ADA. Or a higher sum, which you can claim. If you wish to claim a lower sum, then you have to get your accounts audited, keep your maintained books of accounts, get it audited. Okay, and these, whatever 8%, 6%, 50% all represent your income. It doesn't represent your tax liability. Once you compute the income, then you have to add income under all other heads. Then you have to proceed to compute the tax liability. So these rates represent the income.
Manoj, it's not like that. The only adjustment you have to see, suppose in the income and expenditure account, suppose income tax is debited. Or any personal expenditure is debited, or nothing is there in the additional information. So you have to see the expenditure side and see that this expenditure is not allowed, and you have to add it back. It's not necessary only in the adjustment part you have to see. Other adjustment in which is completely not allowable as per the income tax provision, you have to disallow that.
That's what I said, that you have debited a capital expenditure, personal expenditure, income tax. All those are debited. Municipal taxes in respect of house property. All those things you have to add it back. All those things are not allowable while computing income from house property. So you have to add it back when you take the net profit as per the statement of profit and loss account. Now, 44 AE again, it talks about business of flying goods carriages of assessee owning not more than 10 goods carriages at any time during the previous year. At any time during the previous year. So it's not that a year end he has only 9, he'll be eligible. In between the year, if he had owned 12 also, he would not be eligible for that. At any time of the year, he shouldn't have owned more than 10 goods carriages. Here again, the heavy goods vehicle, what is heavy goods vehicle? That has been defined of what tonnage it should be. That is there in the end of the table. Goods carriage, gross vehicle weight of which exceeds 12,000 kilograms. If it's up to 12,000 kilograms, then it is a light goods vehicle, no other than heavy goods vehicle. Okay. So exceeds 12,000 kilograms, because lots of questions comes like that with 12,000 kilograms, then this heavy goods vehicle rate you cannot apply. You have to apply other than heavy goods vehicle rate. The two things are different. We have an illustration. I think you can go through the illustration in the study material. 1,000 per ton of gross vehicle weight or unladen weight. That you have to see for every month or part of the month in which the vehicle is owned. Not put to use is not relevant here. It's every month in which the vehicle is owned. Suppose I purchase it in May and I put to use in July. I have to count May, June also, even if it's 31st May. I have to count May full month and apply that rate because the rate is per month. 7,500 and other than heavy goods vehicle also 7,500 per month or part of the month during which such vehicle is owned by the assessee. Or here also you can claim a higher sum. Okay. The difference between these three sections is, suppose in case of a partnership firm, the difference arises that where salary and interest paid to partners is deductible in 44 AE case, but it's not deductible in the other two cases. That is in case of a partnership firm. And then when you pay advance tax obligations, these two assessees, 44 AD and ADA, they can pay by 15th March of the year, whereas here they have to pay in 4 installments, 44 AD. So this is regarding 3 things. 1 second. These things are all I have told you now. This one also I have to tell, but I'll take it up after that 44 ADA now that we've started that. Mr. A, an eligible assessee following mercantile system of accounting carrying eligible business under 44 AD, provides the following details. Total turnover is given as 130 lakh. Out of the above, 25 lakh received by account paycheck during the financial year, 6%. Okay. 50 lakh received in cash during the financial year 22-23. This is 8%. 25 lakh received by account paycheck before the due date of filing a return. This also qualifies for 6%. 30 lakh not received till due date of filing return, 8%. So 50 plus 50, 130 it comes in total. Sometimes the last one they might not give you. This sentence they don't give you. So it should not happen that you compute 6% on this and 8% on this and leave this out. 30 lakh, because you have to see the total receipts. So ideally what you should, so whatever qualifies for 6%, 25 plus 25, 50 lakh qualifies for 6%. Yeah? 50 lakh qualifies for 6%. 130 minus 50, 80. Qualifies for 8%. That's the way you should do it. Rather than doing this 50 plus 30, because it may be possible that they don't give you information relating to 30 lakh. It is implied. If they are telling that this much they've received, that means the other portion has not been received. It's accounted for an accrual basis. But you should not make a mistake. So you 6%, whatever qualifies for 6%, that figure you first sum up and then you deduct it from the total turnover of 130 lakh. Okay? So 50 lakh, 130 minus 50 is 80 lakh. So 50 lakh into 6% is 3 lakh. 80 lakh into 8% is 6.4 lakh. So this is 9.4 lakh. Is it clear? I hope it's clear. One thing which I wanted to tell you is relating to employer and employee contribution to PF. Is a matter of great debate. Like in employer's contribution to PF, the Act allows you time up to the due date of filing return for claiming deduction. If the employer has contributed to PF and is remitted it by 31st July, then he can claim it as deduction. But employee contribution, how is employee contribution treated? Employee contribution is first credited to P&L account. It's first deemed as income of the employer. Okay, and then thereafter deduction is allowed if it is paid within the due date under the PF Act, not due date of filing return. I'm talking about employee contribution, employee's contribution in this case, within 15 days from the close of every month. PF Act allows you only time of up to 15 days. So if you do beyond 15 days, even if you do it before the due date, if you deposit the entire sum in July, you're not going to get that deduction. Employer's contribution you will get, but not employee's contribution. So when any question comes, and then what happens? In case of employer contribution, if suppose I don't do it on 31st July, but I do it on 30th November, I'll get the deduction next year. But in case of employees contribution, once I don't do it within the due date under the respective act, I won't get the deduction next year also. See, here it's a simple question. Raj is engaged in the manufacture of textiles since 1/4/2009. His profit and loss account for the previous year 22-23 shows a profit of 700 lakhs after debit credit of the following items. Okay, employer contribution to EPF is 2 lakh. Employee contribution is 2 lakh. It was remitted for the month of March 2023 was remitted on 30th June 2023. Okay, so what all has been demitted? First, I have to presume that both employer contribution have been credited because it's given after debit credit. After debit credit of the following items, this 2 lakh has been done. Then employee contribution, first you will treat it as your income. Thereafter, you will provide for a deduction also. I have assumed that this credit also has, first you have to give the credit, then only debit is possible. But this is the statement says after debit credit, so both has been given effect to for employees contribution. Employers contribution, it's straight away only the debit. So this is the accounting transaction. But what happened? Both were remitted only on 30th June. Okay. For employer's contribution, it's okay because he's done it before 31st July. It's fine before the due date. Then, but for employee contribution, it's after that date, after the 15-day period. So that is not allowable. So this debit of 2 lakh is not allowed. What is not allowed? This credit, of course, it is a deemed income. It is a deemed income. I have to give effect to the entry that it's been credited. It's fine. But debit is allowed only if I deposited within 15 days. 15th April, if I deposited, I would have been eligible for the debit. Now it is on 30th June 2023. So this 2 lakh I'll have to add. This is the treatment I'll have to give in this case. I hope this is clear. There are similar such things here, but if I go through everything, it will become such a long. Here is one such illustration. Okay. Mr. Raj is again engaged in the business of manufacture of textile. His P&L account for 2023 shows a profit of 700 lakhs after debit credit of following items. Interest on loan includes an amount of 80,000 paid to Mr. X, a resident, on which tax was not deducted. Okay, so what should you do? It is debited to P&L account, 80,000, tax is not deducted, simply 24,000, 30% of 80,000 you have to add back. This is a simple thing. But suppose it's the other way around. Mr. Raj is engaged in the business, same thing. And instead of coming in the debit, additional information made, this information is provided. Mr. Raj had credited a subcontractor an amount of 10 lakh on 31/3/2022 towards repairing a machinery component. The tax so deducted was remitted on 31/12/2022. They are talking about the earlier previous year, 2021-22 previous year, in which 10 lakhs has been credited. Fine. That time, but the tax deducted was remitted only on 31st December. So last year, what would have happened? Last year, because it was deposited after the due date for filing return, then 30% disallowance would have taken place in respect of this amount. Last year, they would have added back 3 lakh while computing profits and gains of business and profession last year. But since it was remitted on 31/12/2022, the next year I'll be allowed a deduction. In this year, I will be allowed a deduction of 3 lakh. The amount which was disallowed last year, remitted this year, will be allowed as deduction in this year. I hope this is clear. Anything else you want to know in PGBP? Otherwise, can we proceed to capital gains?
Manoj, Uma, Piyush, Pavan, Mahesh. We hope PGBP is clear to you now.
If you have any specific doubts, we are waiting for your reply. Uma, it's clear? Fine,
Yeah.
good, Uma. Uma is the girl who has replied. So she has understood. What about the others? Chalo, we'll proceed to capital
We
gains.
proceed to capital gains now. Capital gain, if you see the computation performance, it's very simple, but when you go in detail, that for each and everything you have a detailed provision, but in the computation part, like salary, like PGBP, there's no full-fledged big computation chart. It's a simple thing that you have to take the full value of consideration. You have to reduce the expenditure which you incurred wholly or exclusively in connection with such transfer. Net consideration, you can reduce cost of acquisition, cost of improvement. In case of long-term capital asset, index cost of acquisition, index cost of improvement, and you will get the capital gain, short-term or long-term. Then you can claim the exemption from this. Then this. Only this is the computation performer for the capital gain. But in this, for each and every, for determining each and every figure, you have to go through the provision in detail. What is full value of consideration? What is cost of acquisition? What is cost of improvement? How it is determined whether the asset is a short term or long term? What are the exemptions? What are the period of holdings? Everything in detail you have to go for that. So firstly, in the capital gain, firstly we have to see in the any asset chargeable under the head capital gain, it should be a capital asset. So firstly, we have to see what is the capital asset. What is the meaning of capital asset? What are the assets which qualify to be a capital asset? The definition is in under section 214. A capital asset means any kind of a property, whether it's connected or not with the business or profession. Means if I have any building, then it's my capital asset, whether I have hold it as in my business or profession or for my residential purpose or anything, that is the capital asset. Securities held by a FII, foreign institutional investment, then but stock in trade. If suppose I have a real estate business, then the building which I have, that is not my capital asset, because this is not the asset which is for the business profession. It's a stock in trade, because the property, the building is for sale or purchase purpose. It's not for business purpose, business running purpose. So any stock in trade which is consumable as stores, raw material for the business or profession, it's not a capital asset, it's a stock in trade. But in case of a securities of foreign institutional investor, whether the securities are held as a stock in trade, whether the FII has the business of selling or purchase of the securities, in that case also it's a capital asset. It is not a business or profession or anything. It's not a stock in trade. Personal effect, if you have any personal effect of furniture, apparels and anything, that is not a capital asset. But jewelry, archaeological collection, drawing, painting, sculpture, any work of art, that is the exclusion. In the exclusion, it means it's a capital asset. The definition of capital asset is an inclusive one. So all which comes under this definition are the capital asset only. Rural agriculture land. If you have a agriculture land in a rural area, then it's not a capital asset. But you have a agriculture land in an urban area. What is urban area? That is the agriculture land within this specified urban limit. Then it's a capital asset, that is called urban agriculture land. So it's a capital asset. But rural agriculture land is in India only is not a capital asset. If you have a rural agriculture land in other country, then it's not excluded from the definition of capital asset. It's still a capital asset.
If the question simply refers to agricultural land without telling you urban or rural, you normally take it as rural.
So it would not be a capital asset. So next, when you determine the whether the asset is a capital asset or not, then you go to the period of holding. What is, if on the day while transferring the asset, whether the asset is a long-term capital asset or short-term capital asset. There are three time period: 12 months, 24 months, and 36 months for any asset to be classified into short-term capital asset or long-term capital asset. For a capital asset to be a long-term capital asset, if it is a securities that is other than a unit which is listed on a recognized stock exchange, suppose there are shares listed in a recognized stock exchange, then it will be a capital long-term capital assets on transfer if it is held for more than 12 months. More than 12 months, then it's a long-term capital assets. Like unit of equity oriented fund or unit of UTI zero coupon bond, if they are held for more than 12 months, it's a long-term capital asset. If it is held for equal to or less than 12 months, it's a short-term capital assets. For unlisted share, the limit is 24 months. If it is held for more than 24 months, it's long-term capital asset, otherwise short-term capital asset. Similarly, for land building or both. And for the remaining capital asset, whether they are unit of urban oriented debt oriented fund, unlisted securities other than shares, because shares are already covered, whether listed are covered in the 12 months period and unlisted are covered in the 24 months period. So unlisted securities other than shares and whatever the other capital assets, whether it's any other capital asset, whether it's a jewelry, art, work of art, everything that covered under the 36-month category. It means if it is held for more than 36 months, then it's a long-term capital asset. Otherwise, it's a short-term capital asset. There are certain transactions which are not regarded as transfer. Suppose you have gifted your property to anyone else, to someone else. Then in that case, the transaction will not be regarded as transfer. Similarly, on the partition of HUF, whether it's a total partition or partial partition, suppose a holding company transfer its property to its Indian subsidiary company, or subsidiary Indian company transfer it to 100% holding Indian company, then amalgamated company to amalgamating company, vice versa. All this, they are list of transactions which would not be regarded as transfer. So in that case, on that transaction, there would be no capital gain arises.
Prateek, virtual assets के लिए there's a separate provision, okay, and it's one of the special provisions which comes under 115B in that chapter, but it is not included within the scope of intermediate syllabus. So you will not be tested on that.
So any expenses which we have incurred wholly or exclusively in connection with the transfer, that is allowed, but the STD, in case of a shares, if you have paid STD, the deduction on account of STD will not be allowed. But if you have held the share as your stock in trade, suppose you are in the business of trading, then in that case, if you have paid the STT, that would be allowed as deduction because the income is chargeable under the head PGBP, not under the head capital gain. But if you have held any shares or securities as your capital asset, then the STT which you have paid, it would not be allowed as deduction.
In the question that they give you, you should not deduct it. Simple in this.
Cost of acquisition. Like I have discussed that in section 47, there are some transactions which are not regarded as transfer. So in that case, if the asset you have gifted, suppose you have gifted one asset to another person, to any relative or any person, then in that case, cost of the previous owner would be deemed as a cost of acquisition of the transferee. So in the following cases, which is mentioned, like in case of partition of HUF, gift, will, inheritance, succession, like I told, holding company to subsidiary to holding, amalgamation, in everything, whatever the cost of the previous owner will be the cost of acquisition of the transferee. But in case of 49.4, what is 49.4? 49.4 says if on the transfer of such property, if the income is subjected to tax under section 56.210, then the cost of the property will be the value which we have taken for 56.210. What is this means? 56.210. 56.210 says if any person has received any sum of money exceeding 50,000, then the whole of the amount will be chargeable to tax under the head income from other sources. In respect of movable property, if the aggregate fair market value the inadequate consideration, the difference between the fair market value or the actual consideration exceeds 50,000, then the difference will be taxable under the head income from other sources. If it's a gift, if it is without consideration, then fair market value exceed 50,000, then it will be taxable under the head income from other sources. Similarly, in case of a immovable property like land and building, then in that case, if the stamp duty value, the difference between the stamp duty value and the actual consideration exceeds 50,000 or 10% of actual consideration, then in that case, the difference would be taxable as income from other sources. So on. Suppose I'll take an example. There's a Mr. A. He has transferred a property to Mr. B as a gift. In that case, suppose the stamp duty value is, let's take 20 lakh. I'll take a new word for it. Mr. A transferred a land building to Mr. B, the stamp duty value of which is 20 lakh, okay, as gift, without consideration. In that case, 56,210 will get into the picture because Mr. B gets an immovable property from Mr. A without any consideration, and the some stamp duty value exceed 50,000. So in that case, what would happen? 20 lakh. 20 lakh would be chargeable to tax under in the hands of Mr. B under section 56(2)(10). In that case, suppose Mr. B then transferred this property to Mr. C, suppose for 25 lakh. And in the hands of Mr. A, the cost was 10 lakh. He purchased long back, suppose 20 years back, for 10 lakhs. In that case, if Mr. B transferred the property to Mr. C, in that case, the cost of acquisition in the hands of B would be 20 lakh, not 10 lakh, which is the cost of the previous owner. Why? Because 20 lakh is already chargeable to tax in the hands of Mr. B under section 56(2)(10). But suppose in this case, Mr. B is a brother of Mr. A. So in that case, whether 56(2)(10) will attract? No. In that case, because 56(2)(10), in case of a gift to a relative and brother comes under the definition of relative, 56(2)(10) doesn't apply. It means 56(2)(10), that 20 lakh would not be chargeable in the hands of Mr. B under 56(2)(10). In that case, if Mr. B transferred his property to Mr. C, an unrelated party, then in that case, cost of acquisition in the hands of Mr. B would be 10 lakh, which is the cost of the previous owner. So what is the difference between the two? What is the difference between 49(4) and 49(1)? It means if the income is chargeable to tax in the hands of a transferee at that point of time under section 56(2)(10), then that value which we have considered for 56(2)(10) purpose will be the cost of acquisition for the transferee in the case of subsequent transfer. But if 56(2)(10) was not attracted that point of time, due to the exemption which is given, due to the it's gifted to a relative, or suppose it is that it is 56(2)(10) was applicable from 1st April 2009. So suppose if the transaction took place before that, so in that case 56(2)(10) was not there. So in that case, it will fall under the category of 49(1). It means the cost of the previous owner you will have to take.
I hope this is very clear, because this is a very important provision. Because you should understand the difference. Because in one case, in case of gifts, you take the cost of the previous owner. But something which has already been subject to tax in the hands of the recipient under 56(2)(10), you've already paid tax. The simple concept is I've already paid tax on a particular amount on a particular date. So that will be my cost for the future when I'm getting a deduction when I'm selling. Otherwise, it will amount to double tax.
Double taxation. So from this, there is a case of Manjula Jesha. If we see as per the plain reading, as per section 48, in case of a long-term capital gain, what is the index cost of acquisition? Index cost के time पे you will take the indexation benefit of the year in which the asset is first held by the assessee. In this case, suppose it is not a relative, he is not a brother. In that case, when Mr. B first held the asset while transferring the asset to Mr. C. So in that year, you have to take the CI benefit. Okay, but as per the High Court, indexation cost benefit you can take with reference to the year in which previous owner first held the asset and not in the year in which assessee become the owner. So in that case, you can take the CI benefit of 20 years back. You can take the benefit of 20 year indexation benefit for 20 years back as per the Manjula J. Shah case. But now you can't say this is applicable in both the cases. Why? Because you have to take the cost of the previous owner, in which case, in which section 49(1) is applicable. And 49(1) would applicable in the case where 56(2)(10) is not applicable. So you have to see in the first example when I have given that Mr. B is a brother of A, what happened? Mr. B is a brother of Mr. A. In that case, 56(2)(10) was not attracted. So in that case, it would come under 49(1), not 49(4). So in that case, when Mr. B transferred the asset to Mr. C, he can take the CII benefit of the previous owner, that is 20 years back, as per the Manjula J. Shah ruling. But if he is not the brother of Mr. A, then 56(2)(10) gets attracted in the hands of Mr. B. While transferring this to Mr. C, 49(4) attracts, not 49(1). And because of that, Manjula J. Shah ruling can't be applied, and cost of the CIA has to be taken for the year in which Mr. B first held the asset. It is very important, student, to distinguish between the two, 49(1) and 49(4), and apply the ruling of Manjula J. Shah in the correct situation. You can't apply this ruling in both the cases. I hope it is clear the difference between 49(1), 49(4), 56(2)(10) and the Manjula J. Shah case.
We want you to be more interactive, so that we feel that people are actually listening, or whether you've understood, not understood. The more you interact.
Manoj, Uma,
Pratik,
Piyush,
Suprada,
I hope
any particular doubts? This provision is clear because it's an important provision.
It's an important provision.
Actually, we are trying to cover whatever the points which generally students tend to go wrong in the examination. So that's why we are telling you so much in depth, so that you don't make the same mistake. So you pay careful attention. 49(1) and 49(4), the difference, it's very important that you understand the difference between the two. I hope all of you have understood.
Come on, students, we are waiting.
Good, Abhishek. This is another important provision. Please listen to it very carefully. 50C is a very important provision, often tested provision. See, if you know these mistakes, you can avoid these mistakes in the examination. That's why, rather than concentrate on some amendments which may not have a direct impact on your answers so much, we are concentrating on the provisions which are more tested and which students generally tend to go wrong. So, and capital gains is a very important chapter, and 49(1), 49(4), 50C are all very important provisions. So please pay careful attention.
50C. In case of the land and building, suppose you have transferred land and building, then in that case, what would be the full value of consideration? And along with that, your 43CA will also be covered in this case. 50C would attracted in case where the land and building is a capital asset in the hands of the transfer, and 43CA would be attracted if it is stock in trade in the hands of the transfer. Both provisions are same in both the sections. Only difference is then when it is taxable under the head capital gain, but is or another is taxable in the under the head PGBP. When it is stock in trade, it is taxable under the head PGBP. When it's a capital asset, it is taxable under the head capital gain. If the stamp duty value of the land and building is exceeds actual consideration, then what would be your cost of what would be your full value of consideration? If your stamp duty value exceeds 110 exceeds more than 110% of actual consideration, it means suppose your stamp duty value is 50 lakh and your actual consideration is 30 lakh. In that case, 110% is 33 lakh. So stamp duty value exceeds more than 110% of actual consideration, then your full value of consideration will be the stamp duty value. But if it is less than or equal to 110% of actual consideration, suppose it's 32 lakh and 30 lakh, then in that case, actual consideration will be the full value of consideration. But if actual consideration is higher than stamp duty value, then there is no worry, that actual consideration with the full value of consideration. That is applicable in both the cases, in 50CA also and 43CA. Many times it happens that you have made an agreement for transfer very much earlier, and on the date of a transfer, there is some stamp duty value is different from the stamp duty value on the date of agreement. In that case, you can take the stamp duty value on the date of agreement only if whole or any part of the consideration is received by account pay check, bank draft, ECS, or prescribed mode, means UPI is net banking debit card, on or before the date of agreement. Suppose the date of agreement is 1st November and on that stamp duty value is 50 lakh. Suppose on 1st February you have transferred and registered the transfer date, and in that case 60 lakh is the stamp duty value. So definitely, if you take this value and this become your full value of consideration, then your capital gain will be higher and you have to pay higher tax. So you can take, as per the provision, you can take the stamp duty value as on 1st November on the date of agreement only if whole or any part of the consideration. Suppose consideration was 40 lakh. Any part of a consideration you have received on or before 1st November to 1st November by any of these modes. If you have received in cash, then this beneficial provision will not be available. Only if in the prescribed mode you have received a whole or part of the consideration, then only it will be available. So similarly in 53 CA. In the earlier BoS for success, we have covered a very extensive question of regarding 56, 210, 43 CA and 50C, where in detail we have discussed whether if the asset is held as a capital asset, then what will be the taxability under 50C and 56 to 10, and if it is held as a stock in trade, then its taxability under section 43 CA and 56 to 10, and what is the relation. So this is the link of the earlier counseling session. So it's advised for that this provision, the in 50C, 50C, 56 to 10 and 43 CA, you just view the session from this link.
This is a very important thing which you have to understand, because how the sections play, what happens if a person holds an asset as a stock in trade, land and building, and what happens if he holds it as a capital asset in the hands of the transferor and the hands of the transferee also. Transferee 56 to 10 is attracted only in case of a capital asset. But in case of a transferor, if it is a stock in trade in his hands, then it will be business income. Or if it's a capital asset, it will be capital gains. Then in the hands of the recipient, it has to be a capital asset, only then that provision is attracted. And accordingly, how the tax treatment will be. Then the TDS application, everything has been very well covered. There's a chart in the study material also. Detailed chart, flow chart. It's after income from other sources.
It's in the income of other sources. Income from other sources. I have just taken you to that chart. But before that chart, you just go through that chart. But before that chart, please read 50C, 56 to 10, 43 CA, and TDS also. So you will get the holistic picture. This is the chart. So you can refer it in from your study material, this chart.
I hope all of you are reading the study material, doing the things in the study material. See, many of you some of you may be taking coaching from outside and all those things. Those are all fine, but study material is compulsory. Study material, the questions therein, let us recapitulate, and all the other flow charts and tables which we've given because we know like what we are seeing, what comes over the years, what are the provisions which are being tested, where the children are going wrong. Accordingly, the questions are being framed. Accordingly, the charts are being presented. So all of you should do it as a compulsory exercise. You have to do all the, let us recapitulate all the charts and diagrams given in the study material. Every example and every illustration test your knowledge question. And surely you will score well in the exam. Once you do this exercise, maybe you will find it difficult to put yourself through this entire process. This point of time, you'll find it difficult, but in the examination, you will definitely do well.
The next topic is advance money received and forfeited. Suppose you have,
which is a lengthy topic. It depends, like I would say salaries. Personally, if I have to do myself, it would be salaries is this thing. Complexity may be more in capital gains. Complexity level is capital.
So suppose you have undergone a transaction for transfer and it doesn't conclude. Then in that case, the amount which you have received is forfeited. Then in that case, what will be the treatment of that amount, that advance money which you have forfeited? So if the advance money is received and forfeited before 1st April 2014, then there is a different tax treatment. If it is received and forfeited after 1st April 2014, then is a different tax treatment. If you have received, the transaction took place before this and you have received the advance and which is forfeited, that in that case, the advance which you have forfeited, you have to reduce it from your cost of acquisition while you subsequent transfer the property. So in that case, what will happen? Your cost of acquisition will get reduced by the amount which you have forfeited. So your taxability get postponed till subsequent you actually undertake the transfer. But if if the amount was forfeited on or after 1st April 2014, in that case, whatever the advance you have received forfeited would be taxable under income from other sources under section 56(2)(9). So in that case, what happened? In the year in which you forfeited the advance, it is taxable in that year only. So there is no postponement of taxability in this case. So it is very important to denote the date also, because in the question it will be clearly mentioned that the transfer was supposed to happen and it was not concluded, and you have to accordingly do that adjustment for that.
The asset will be transferred this year. Final transfer will be taken place this year. And for that, when you compute the cost of acquisition, if earlier it was a subject matter of transfer but didn't materialize, advance was forfeited. So in such a case, current year the transfer is taking place. What will I take as the cost of acquisition? From that cost of acquisition, I have to reduce the advance forfeited before 1/4/2014. Before. If it's after that, it would have been taxed under other sources at that very point of time. So there's no need to again deduct it from my cost of acquisition.
And while you are reducing the advance from the cost of acquisition, it should be reduced from the cost of acquisition, then indexation will be applied. Should not do that. The cost of acquisition pay, you apply the indexation benefit, and the amount forfeited separately, you do the indexation and you reduce that. Cost of acquisition, whatever, suppose you have purchased in 2005, that transaction not concluded in 2009, 2022-23, you are transferring the property. Then the cost, whichever is on 2009, you are supposed to reduce the amount forfeited, which you have forfeited in 2009, and on the remaining, you have to apply the indexation by considering the CIR of 2005. So don't do the indexation of 2009 for the amount forfeited.
Manoj thinks PGBP is lengthy. So he says salary is easy for him, but PGBP is lengthy. PGBP is okay. There are some provisions, but it's not exactly so lengthy as salaries is. Of course, it's a personal perception then, but it's easy. PGBP is easy.
Actually, if you see salary, it's basically limit. You have to memorize the limit and calculation is there. But in PGBP and capital gain, the provision testing interpretation is there. So that's why PGBP and capital gain gets little bit difficult for students.
This again is very important. 112, 112A, 111A are very important sections because these are special rates of taxation. Normal slab rates, otherwise it's covered in the general. Initially, we told you what are the slab rates are, but these are provisions wherein the tax rate is mentioned in the particular section only, and special tax treatment is there. So pay careful attention.
Whether the assessee is opting for BAC or not, individual is opting or not, income under is taxable under these three heads only. Capital gain will not. There is no separate rate if the individual is opting for BAC or not. The special rates under this section will remain the same. So if any capital asset, whether it's a listed equity share and equity oriented fund, then and it is a long term capital asset, then it will be taxable under section 112A if STT is paid on acquisition and sale. If it is STT is not paid on acquisition and sale, then definitely it will go under section 112. If the same asset, listed equity shares, unit of equity oriented fund, but it is held for less than or equal to 12 months, then it will be a short-term capital gain. In that case, the condition is only at the time of acquisition, STT should have been paid. If STT is not paid at the time of acquisition, then it will be taxable at normal rate of tax, which is other normal short-term capital gain is taxable. Other than these two assets, if there is any other asset and it is a long term, then it is taxable under section 112. And any other asset apart from this, which is a short-term capital asset, it is taxable. That will be taxable at normal rate of tax. Suppose land and building is there and it's a short-term capital asset, then normal rate of tax. But it's the land and building and long-term capital asset, then 112. Deduction, you will not get deduction under chapter 6A in respect of any of the above, so there will be no deduction from chapter 6A. Regarding the rebate, specifically it is denied that there will be no rebate under section 87A would be available in respect of long-term capital gain taxable under section 112A. So it means if your income is taxable under section 112 and 111A, then you can claim the benefit of rebate under section 87A. What is the rate of tax? In case your capital assets falling under the 112A, then it's 10% on capital gain exceeding 1 lakh. Suppose you have a capital gain of 5 lakh, then on 4 lakh it is 10%. In case it's a short-term capital gain taxable under section 111A, it's 15%. And in other cases, if it is listed security other than units and zero coupon bonds, then 10% without indexation and 20% with indexation, whichever is more beneficial for the assessee. So if in respect of other asset, suppose it's a land and building or it's a unit, then it's 20% with indexation. Only in listed securities, which is other than units, and zero coupon bond, you have to compare which is more beneficial for the assessee. Regarding the basic exemption limit, in case you are a resident individual and an HUF, then the basic exemption limit, which is unexhausted, you can exhaust from all of these three, whether it's 112, 112A and 111A. What is rebate under section 87A? The rebate under section 87A.
Mahesh, okay, before Mahesh is asking for a break, I can understand because it's been 3 hours. We would just like to get your opinion. Would you see, because it's already 3 hours and we have this thing, if there's an important amendment after this in TDS. See, we were actually planning for clubbing this thing and all, but there's no time for everything. But TDS may this 194Q 206C 1H, if you are finding it okay, you are able to sit through it, then we will continue with that. Otherwise, we will stop it after capital gains. What would you say? Depends upon your response whether we will take it up or not. And we want your response for that. Break we will give. In such a case, we'll definitely give a break, Mahesh. We understand.
Mahesh, Manoj, Uma, tell us what you want.
Otherwise, we'll wind up with this one. Do you want us to take 194Q 206C 1H?
That is very much
provision?
interesting because there's an interplay between 194Q, 206C, 1H, 206C.
It's a little bit complicated, so we thought we will cover that up. Even though it's cross the time, but it depends upon your response if you're willing to sit. We would like to have your response quickly.
Mahesh is okay with that. Uma, Prateek, everyone.
We are telling the names because those names are appearing here. Others can also respond.
Piyush, Supradha,
Puneet. Uma Priya says we can continue. What about the others? Suprada, Prateek.
Okay, Piyush, we understand that you have a class from 6 because
we will wind up by 5:30, 5:35, 40.
Because we actually really want you to understand that provision 190 TDS and TCS, and you will definitely find interesting.
So to continue the debate, and then we'll have a break for 5 minutes, and then we'll just take up the TDS provision.
TDS TCS provision, which will take half an hour. Maximum. Rebate that is available to an individual who is resident. Only individuals and who are resident, they can rebate under section 87A is available to them. For that total income, your total income should not exceed 50 lakh. And rebate, what would be the rebate? That income tax.
5 lakh. I think by mistake.
Sorry, 5 lakh. And the amount rebate would be the amount of income tax or rupees 12,000, 1,500, whichever is less. So rebate under section 87A, it's to be allowed before you add HEC, health and education cess. After that, if something else, any income is tax is payable, then you have to add HEC. I have already told you that in respect of 112A, you will not get rebate under section 87A. Regarding the rebate, please be very careful. If suppose you have any income which is taxable under section 112, suppose 4 lakh. So in case of 4 lakh, okay, that will be taxable 15%, 1 lakh. Suppose this is the case, Mr. A is a resident individual. He has long-term capital gain under section 112 only of 4 lakh. And he has no other source of income. Then in that case, he can adjust the basic exemption limit against 112 because he's a resident. Then in that case, what would be his remaining income? It's 1,50,000, which is taxable at 20%. So what will be tax liability? It's 30,000. So in that case, normally what the student, that kind of mistake student can do, that 4 lakh, it's less than 5 lakh. You tend to give there's a rebate of 12,500 wholly, and there will be nil tax liability. No, in case of a special rate, definitely your income tax liability will arise. There will be no nil tax liability. It arises only when there is total income does not comprises any special rates. In that case, what would happen? 5 lakh, you adjust the basic exemption limit, then on the remaining you will get 5%.
Yeah.
So it's 12,500.
And your rebate is also 12.
Rebate is also there. There will be no tax liability. But in case of a special rate, you have to compute and then give 12,500 rebate and HEC on that. It's a very important. So keep in mind while in the exam.
So this is not available when in respect of 112A, but it's available in respect of 111A and 112.
I hope till now everything is clear to you.
In case some doubt is there, you can ask, and then we'll go in for a 5-minute break. Students, you want break or they want to continue? Somebody wanted break in between. Actually, I doubt whether there's a class at 6 o'clock today. Ajit, today there's a class at 6 o'clock.
Intermediate,
Hey.
you know.
Intermediate, there's no class at 6 today. There's no class at 6. Who said that? Piyush, na? There's no class at 6. Okay. So
So students, just tell us if you want to take, do you need a break of 5 minutes or should we continue with the TDS TCS? Ajay,
There's a
corporate
class.
and another class edge. Piyush, just let me tell you that today's class for corporate and other law is cancelled. There is no class for today evening.
Can we continue?
Okay, Piyush, let me check on the YouTube if it's coming and we will see. But there is no class. That is for your information. In the YouTube, I'll just check on the YouTube if it is there. BoS app also is sent. It is removed, Piyush, actually. Well, for sure, there is no class. We will check if it is coming in YouTube or BoS app, but there is definitely no class today for corporate and other law.
Okay, so we'll continue. So we'll try to wind up as quickly as possible. Basically, what we wanted to tell you was the interplay between TDS and TCS. So the provisions of 194Q and 206C1H, these two basically, but for that you have to understand the other provisions also. So as far as tax TCS is concerned, 206C1, there is 261F, 1H. There are other sections also. The other sections are, because these three, the interplay is involved, we are basically taking these three sections. So 206C1, what does it talk about? It talks about collection of tax at source in case of sale of these goods. Alcoholic liquor for human consumption, the rate is 1%. Tendu leaves, 5%. Timber obtained under forest lease, 2.5%. Any other mode, it's 2.5%. Other forest produce not being timber or tendu leaves, it's 2.5%. Scrap is 1%. Minerals being coal or lignite or iron ore, that is 1%. So these are the rates specified in 206C1. Okay, these are the things specified. 206C1 talks about motor car. This is motor vehicle. Motor vehicle. This 261F talks about motor vehicle. 1H talks about all other goods or services not covered within any of the provisions mentioned earlier. And 194Q is TDS by the buyer. And 206C is TCS. TDS is the person who makes the payment. The buyer generally makes the payment. So he has to deduct tax at source. The seller collects the payment. He's the recipient. He has to, TCS responsibility is cast on the seller. TDS responsibility is cast on the buyer. Okay. Now, as far as the items into TCS is concerned, these items which we saw, the rates have been specified thereunder. It is at the time of debit to the account of the buyer or at the time of receipt, whichever is the earlier. Okay. This is at the time of debit. TCS under 206C1F is in case of motor car. Motor car of the value of exceeding 10 lakhs. Then it's 1% of sale consideration. This is collection by the seller and this is at the time of receipt. This is debit or receipt, whichever is earlier. This is at the time of receipt. Then next section is 206C1H. That is the other goods and services. That is again at the time of receipt. It's 0.1% of the sale consideration exceeding 50 lakhs from a buyer. From a single buyer, if you're doing more than 50 lakhs, then it is attractive, TCS under 206C1H, and the seller's turnover should exceed 10 crore in the earlier financial, immediately preceding financial year. That is, now we are talking about previous year 22-23. So immediately preceding previous year's financial year 21-22. So the seller's turnover should exceed 10 crore in financial year 21-22. And in the current year, the purchases, the sale to a particular buyer should exceed 50 lakhs. Then TCS under 206C1H will be attracted at 0.1%. Then TDS, what does it say? TDS is at the time of payment of credit, whichever was earlier. This is in the hands of the buyer. Then here again, it's 0.1% of the value of purchases exceeding 15 lakh and the buyer's turnover should exceed 10 crore in the financial year 21-22. So that is where the clash comes up. Suppose there's a transaction of purchase and sale, which should proceed first, whether it's 194Q or 206C1H. So that is where the clarification becomes very important. And what about those goods which are already covered in 206C1, 206C1F? In that case, what happens? That is where we need a clarification. So now we take the order first. Now, if it is goods covered under 206C1, then tax has to be collected at source by the seller. In respect of these goods, if tax has been collected under 206C1, 194Q will not apply. Okay, so this takes precedence. 206C1 takes precedence. Now, then, but what? The 206C1A provides some exceptions where 206C1 will not apply. If the person who is buying the goods, they says that he gives a declaration that the goods should be a resident buyer. Of course, he should be a resident buyer and he should be using it for manufacturing, processing, producing articles of things or for generation of electricity and not for trading purposes. And if he gives a declaration, then no tax is collectible. But okay, this is under 206C1, no taxes collectible. But what about 194Q? What about 206C1H? The CBDT circulars clarify 206C1H is also not attracted. No TCS is attracted. If it's not attracted under 1, it's not attracted under 1H also. But in the hands of the buyer, if the turnover of the buyer in the financial year exceeds 10 crore and the value of purchases exceed 50 lakhs, if both these conditions are satisfied, then TDS under 194Q is attracted 0.1% of the consideration in excess of 50 lakhs. 0.1%. No, all these rates will not apply, but 0.1% in excess of, provided the buyer's turnover exceeds 10 crore in the previous year and the value exceeds 50 lakhs. If the value is less than 50 lakhs, then no TDS, no TCS. Only if the value exceeds 50 lakhs. And suppose what if the buyer's turnover is only 8 crore in the previous year? Then TDS is not attracted. TCS in any case will not be attracted. So this is as far as 206C1 is concerned. Is this clear? Now let me come to 206C1F. That's attracted in respect of sale of motor vehicle of the value exceeding 10 lakh. In that case, 1% of sale consideration 206C1F is attracted, so nothing else will be attracted. But there are many permutations and combinations here. If the sale of vehicle exceeds 10 lakh by a manufacturer to dealers, distributors. In this, there is a clarification that 206C1F is not attracted. If it is a sale of vehicle of value exceeds 10 lakh is okay. But it's by a manufacturer to dealer, distributor, then there's earlier itself a clarification had come that 206C1F is attracted, not attracted. So if it's not attracted, then what about 194Q and what about 206C1H? This is 194Q. This is 206C1H. This is 206C1H. Okay. Now here it's not attracted ticket. Then why 194Q is attracted? Yes, provided the turnover of the dealer in the previous year 21-22 exceeds 10 crore and the value of motor vehicles purchase exceeds 50 lakhs. If it does not exceed 50 lakhs, then nothing will be attracted. Everywhere it will be exempt. Even if it exceeds 50 lakhs, if the dealer's turnover is less than 10 crore, then 194Q will not be attracted. Then what will happen? If this is not attracted, only then you go to 206C1H in this case. In the earlier case, even if this is not attracted, you won't go to this. Because it's clarified in the CBDT circular that 206C1H will not be attracted. Where in a case of 206C1A, there I told you this also will not be attracted. But in all other cases, if it's not attracted in the hands and under 194Q, we have to see the applicability under 206C1H. Here you see, if dealer is required, then you need not go into it at all. If 194Q is, if it's not attracted, then you have to see in the case of the manufacturer whether his turnover exceeds 10 crore in the previous year 2021-22. If the answer is yes, whether the current year sales exceeds 50 lakhs, if the answer is yes, then this will be attracted. If either one of the answer is no, this also will not be attracted. I hope this is clear. Piyush Chopra, just tell me which one you're not clear about. Let me. He is not able to understand. He is telling it's going over his head. So let me explain it again. Which one is going? Exactly what is your doubt? What I was trying to say is the order. If any item is covered, it's the interplay between these four sections. Let me repeat. 206C1, 1F, 1H, and 194Q. Why the problem comes is because these two sections have been recently inserted and they talk about all goods and services. Because it's generally all goods and services, somewhere those goods and services would have already been attracted TCS under 206C1, under 206C1F. In such a case, what happens? If specifically under 206C1 or 206C1F, tax has been collected, then neither 194Q nor 206C1H would be attracted. Specific provisions of TCS, 206C1, 206C1F, tax has already been collected, then neither 194Q will be attracted nor 206C1H will be attracted. The problem comes when this has been, some specific exemption has been claimed, like under 206C1A for manufacturing processing, so you don't collect tax. Then what happens? Then it falls under the residuary clause. Residuary clause, where it normally would have fallen under 206C1H, but circular has clarified 206C1H will not be applicable in a case where the person uses for manufacturing. In that case, 1H will not be attracted, but 194Q will be attracted, provided 194Q attract. For that, what is the condition? Condition is that the buyer's turnover should exceed 10 crore in the previous year and the particular transaction with the person should exceed 50 lakhs. Only then 194Q will be attracted. If these conditions are not satisfied, even if it does not attract TCS under any of the other provisions, it won't attract TDS here also. I hope this is clear. Others speak up. Abhishek, Manoj, Uma. First, 206C1. Okay, you have to see. Okay, then 194Q, because these two are mutually exclusive. So this is motor car, this is all these products. So this you have to give first priority. After that, 194Q, then 206C1H. This is the, okay. Piyush, if you can tell me a specific doubt, na, I would like to solve it, because there's no point if you don't understand. Now we talked about motor vehicle. Now, if the motor vehicle value does not exceed 10 lakhs and aggregate value of all motor vehicles sold by the seller to the buyer does not exceed 50 lakhs. If it does not exceed 10 lakh, then 206C1F is not attracted. That is very clear. Then aggregate value does not exceed 50 lakhs from the particular seller, then both are not attracted, because that is one of the primary conditions. So this is very clear. Okay. Then sale of motor vehicle of the value not exceeding 10 lakh. So value not exceeding 10 lakh means 206C1F won't apply. But aggregate value of all motor vehicles exceed 50 lakhs. Sold by the seller to the buyer exceed 50 lakhs. In this case, we have to see 206C1F is not applicable because the value does not exceed 10 lakh. Then we have to see 194Q and 206C1H. Always remember, between 194Q and 206C1H, first the liability is on the 194Q. 194Q may the buyer is not liable to deduct by virtue of his liability being less than turnover being less than 10 crore in the previous year. Only then the seller will be liable to deduct tax under 206C1H. So between 194Q and 206C1H, it's always 194Q first. You have to see if 194Q is attracted, then there's no need for the seller to deduct tax under 206C1H. But if tax is collectible under 206C1 or 1F, then those two sections will take priority over 194Q. That is why I put it in that particular order. These two sections will be given the first priority if tax is collectible. If not collectible under these two sections, then you have to come and see whether 194Q is attracted and 206C1H is attracted. Clear? Clear, Piyush? I want your answer. Mahesh, Uma, who are the others who are? Please respond so that I can proceed further. Please. Now, Now you're clear about motor vehicles. If the value exceeds 10 lakh, directly it comes under 2061F. But 2061F provides exemption for dealers, sale by manufacturers to dealers and distributors earlier itself, because this section has been there for many years. Earlier itself, there was an exemption for manufacturers and dealers. So that time there was no tax collectible. But now a new section 194Q has come, 2061H has come. So it will fall under that clause. If 2061F does not get attracted, we have to see whether 194Q is attracted. 194Q, when it will be attracted if the value exceeds 50 lakhs. If the value does not exceed 50 lakhs, we need not see anything else. If the value exceeds 50 lakhs, then we have to see whether the buyer's turnover exceeds 10 crore in the previous year. If it does not exceed, then 194Q goes out of the picture. Then you have to see 206C1H. 1H, then seller's turnover, whether it exceeds 10 crore. If it is yes, then 206C1H may gets attracted. You have to see if it does not exceed 10 crore, then neither TDS nor TCS is attracted. Oh God. Piyush, then what I would advise you is, suppose you find that you've already done it, you see the recorded lecture then. In case of any queries, you can always post it in the BoS mobile app. If you feel that it's becoming too much for you and you're not able to concentrate now, see the recorded lecture, because it will be available later on also. You can see it later on. In case you have any doubts, you can post it in the BoS mobile app. Fine. Then now we come to, we've talked about specific instances, motor vehicles, then about the 206C1A cases, then about the residuary cases. If aggregate value of goods sold by seller to buyer is 50 lakhs or less, then there is no TDS TCS if it's not. Then if the aggregate value of goods sold by seller to buyer is more than 50 lakhs, then first you have to see application of 194Q. Yes, if turnover of buyer exceeds 10 crore in the financial year 21-22, then 194Q will be attracted. First, you have to see this. Then if not, if the turnover of buyer is less than 10 crore, suppose it's say 8 crore, then 194Q won't be attracted. Then you have to see seller. If 194Q was attracted, then you need not see 206C1H at all. But if this is not attracted, then you have to see here. If seller's turnover exceeds 10 crore, you have to see, suppose his turnover is 11 crore, yeah, he has to deduct tax at 0.1% of the amount exceeding 50 lakh. That you have to see. Suppose its amount is 60 lakh, only on 0.1% of 10 lakh you have to collect tax. So same with TDS also. It's the amount exceeding 50 lakh. Okay. If it exceeds, provided his turnover exceeds 10 crore, but if his turnover also doesn't exceed 10 crore, then there's no liability of TDS and TCS. Okay. We have one case scenario for that. This is in our RTP.
Yeah.
This time's RTP, it has been included. This is on this concept. There's an additional TCS provision also. Because it was not involved in that interplay, I did not take it up there. In case of lease of a parking lot, mine, and all, coal mine and all, then tax is collectible by the lessor at 2%. It is 2%. Let me just confirm.
Yes.
2%. Fine. That is under 206C1C. That provision is also applicable in this particular case scenario. Now let us see. Kishore and Sons is a dealer of coal. Okay. Its turnover for the year was 12 crores. Fine. Then it's higher than 10 crores. First, Kishore and Sons turnover is greater than 10 crores. The state government of Hyderabad granted a lease of coal mine to Kishore and Sons on 1/5/2022 and charged 11 crores for the lease. Okay. Here 206C1C will be attracted because in the hands of the lessor, the 206C1C is getting attracted. So tax has to be collected at source. Then Kishore and Sons sold coal of 95 lakhs to BAC company during the previous year 22-23. It sold coal. So it's a seller. For this transaction, it's a seller. XYZ Limited purchased coal of 55 lakhs from Kishore Lal and Sons for trading purpose in July 22. Turnover of XYZ Limited during the previous year 21-22 was 12 crores. PAN is duly furnished by the buyer and seller. Details of sale to and payments from BAC and company by Kishore and Sons are as follows. So, date of receipt, date of sale is given. Totally, first, let's see how much the amount is. 35 plus 25 is 60, 68, 60, 75 plus 20, 95 lakhs. So it exceeds 50 lakhs. It's 95, na? 60 plus 20? 95. 95 lakhs. So we have to see which date of sale, date of receipt of payment. Suppose tax is deductible by the buyer. Buyer ke haath mein suppose tax is deductible. Then you see earlier of the two dates. Earlier of the two dates, in this case, it's 10/5/2022. Here it's 36/2022. Here it's 25/10/2022. Here it's 21/2023. And here it's 15/2023. Okay? But actually, in this case, it won't matter because it's less than 50 lakh. Now come to turnover of BAC. During the previous year, 21-22 was 11 crores. So as far as we see, all the parties have turnover about 10 crores in this case. So we have to see each case, what is the thing. The above amounts were credited to Kishore and Sons account in the books of BAC on the date of sale. BAC has furnished a declaration to Kishore and Sons that coal is to be utilized for generation of power. This is important. So 206C, 1A comes into picture here. Okay. Now let's see what are the questions now. Who is required to collect tax at source in respect of lease of coal mine by the state government of Hyderabad to Kishore and Sons and at what rate? Okay. Now this is a case covered by 206C 1C. There's a lease of coal mine by the Hyderabad state government to Kishore and Sons, and they've charged 11 crores for that. So under 206C 1C, the lessor, that is the state government of Hyderabad, has to collect tax at source at 2% of 11 crores. So that is the answer for this. If it's specific provisions of 206C 1C, 1F and all, that will prevail over 194Q. So the state government has to collect tax at 2% on 11 crores. Able to collect. First answer. A would be the correct answer in this case. Then second one, is Kishore and Sons required to collect tax at source in respect of sale transactions with Mrs. BAC and Company? If yes, when and what is the amount of tax to be collected? Let's see what is the transaction with BAC and Company. Kishore and Company, Sons. Okay. Kishore and sold coal of 95 lakhs to BAC Company during the previous year, 2021-20. Okay. It sold coal of 95 lakhs to BAC and Company. Now, what are the particulars? Later on, what did we see? BAC ka turnover also exceeds 11 crores. Kishore and Sons turnover also exceeds 10 crores. So that is not a problem. BAC Company the buyer furnishes a declaration to Kishore and Sons that the coal is to be utilized for generation of power. So under 206C 1A, it is exempted. Otherwise, 206C 1A tax would have been attracted. If the declaration had not been furnished, tax TCS under 206C 1 would have been attracted. Now, because BAC has furnished a declaration to Kishore and Sons that coal is to be utilized for generation and power, Kishore and Sons need not deduct tax by virtue of 206C 1A. Now what will happen? TDS provisions under 194Q has to be seen because 206C 1H is not attracted. That in the case of manufacturing, such declaration is furnished means 206C 1H will not be attracted irrespective of the turnover. Okay? 194Q has to be seen whether the provisions of 194Q are attracted. Now the turnover, who is the buyer, who is the seller here? Kishore and Sons is the seller. Okay, so seller ke haath mein there is no TCS because of 206C 1A. Buyer BAC. What is BAC's turnover now? BAC's turnover is 11 crores. It exceeds 10 crores. So that condition is satisfied and the transactions exceed 50 lakhs. So that condition also is satisfied. So TDS under 194Q is attracted at 0.1% of the amount exceeding 50 lakh. Now, when does it exceed 50 lakhs? On this date, it exceeds because here it becomes 60 lakhs. So 10 lakhs means you have to collect at 0.1% here. Then these things fully 8 lakhs on 25/10/2022, 15 lakh on 21/2023. So the amount will be 10 lakh into 0.1% is 1,000 rupees. Is it? Just 1,000 rupees. 1,000 rupees. 1,000 rupees on 36/2022 800 rupees on 25/10/2022, then 1,500 rupees on 21/2023, and 1,200 on 50/2023 in the hands of the buyer. Buyer is BAC, in the hands of BAC. Kishore and Sons mein, there is no requirement to collect tax at source because this person 2061 would have been attracted had he not furnished a declaration that he is using it for the purpose of generation of power. But since he has furnished the declaration under 2061A, it is exempt. 2061H is not applicable in this case. So the question requires, is Kishore and Sons required to collect tax at source in respect of sale transaction? If yes, when and what is the amount of taxes to be collected? Here, no, Kishore and Sons is not liable to collect tax at source. There is another question on deduction. Fourth question. I come straight, I skip the third one because it's a related question. Is BAC company required to deduct tax at source? If yes, and when and what amount? Yes, it is required to collect tax on the amount exceeding 50 lakhs. So it will be 1,036 2022, 825/10/2022, 1,005. I think it's the first option. 36 2022, 25/10, 21, and 15/2. Let's see. 36, 25/10, 21, and 15/2. 1,800, 500, 1,500, and 1,200. 1,800, 1,500, and 1,200. So fourth one, BAC company is required to collect tax. Fine. Is it clear? This part, is it clear to everyone? I would like your response. Abhishek, Uma Priya, Piyush will watch the recorded one. Others, Abhishek, Manoj. Uma Priya, is it clear? The thing is, actually, under 206C1, the tax liability would have arisen in the hands of the seller, Kishore and Sons. But what happened here, the buyer, BAC, furnished a declaration that he is going to use that coal because coal is one of the items listed under 206C1. So in the first instance, 206C1 would have been attracted. But the buyer, BAC Limited, has furnished a declaration that they're going to use for the purpose of generation of electricity. So TCS provisions, they are exempted from. Then what happens? We have to check in the hands of the buyer. Here, the buyer's turnover exceeds 10 crore in the earlier previous year, it's 11 crore. And then the transactions is 95 lakh, which exceeds 50 lakh. So 194Q gets attracted and the rate of tax would be 0.1% and in the 4 different dates. The credit or payment, whichever was earlier, we have to take in case of 194Q. So that's why we were seeing the earlier of the dates. Had it been 206C1 also, would have seen the earlier of the dates. It's under in 206C1H when you see, you have to see only the date of receipt. But in this case, 206C1H is not applicable. That has also been clarified in the circular. Now we come to third question. Fifth MCQ is related. Fifth is also related. Okay. Assume for the purpose of this MCQ, BAC's turnover for the financial year 21-22. That is the BAC is the buyer. No? His turnover we had given as 11 crore. So we had applied 194Q provision. Suppose the turnover was only 9 crore. Who will be required to deduct or collect tax at source in respect of the transactions? Now I want you people to answer this. Suppose BAC company. BAC is now required to deduct tax at source. Its turnover, on the earlier question, it was 11 crore, so TDS was attracted under 194Q. Now we are telling, ignore that 11 crore, the turnover is 9 crore. Now who will be required to deduct tax at source in respect of the transaction? Now the 95 lakh transaction, this transaction, who will be required to deduct tax? It's a sale of coal by Kishore and Sons to BAC. BAC has furnished a declaration that it's going to use for the manufacture, it's going to use for the purpose of generation of electricity, generation of power. Okay, so that's why 206C1A, it was exempt. Then we saw 194Q. The turnover of the buyer was exceeding 10 crore and the total transactions was exceeding 50 lakhs. So we applied 194Q. Okay, but now you're talking about a case where the turnover is 9 crore. In such a case, who is required? What is the answer now? Is there any liability to collect tax? Is there any liability to deduct tax?
Uma, Abhishek, Mahesh.
Ankit Kumar, you answered Kishore and Sons.
So it means your answer is, you are telling
First,
B.
B, his answer is. What about the others? You've understood the transaction. It's coal, item listed in 206C1, but the buyer has given a declaration. So 206C1A was attracted. So no TCS under 206C1. Then we examined 194Q. So the buyer's turnover was more than 10 crore. Total transaction value was more than 95 lakhs. So buyer was required to deduct tax at source. BAC was required to deduct tax at source under 194Q on the earlier of payment or credit, whichever was earlier. That provision we applied in the earlier MCQ and we arrived at the answer. Now we are telling next MCQ, no, his turnover is not 11 crore. If it's 9 crore, now what will be your answer? This is the whole situation. I want your answers. Uma, these are the four options. Kishore and Sons is liable to collect tax at source at 1% of 95 lakhs. Kishore and Sons is liable to collect tax at source at 0.1% of 45 lakhs, being the sum exceeding 50 lakhs. BAC is liable to deduct tax at source at 0.1% of 45 lakh, being the sum exceeding 50 lakhs. Neither Kishore and Sons is liable to collect tax at source, nor BAC is liable to deduct tax at source. Which of the four options are right? Can we have your answers, please? Even if it's wrong, it's okay. There's no issue. As I said, it's okay. If you've made a mistake now, it's very much okay. When I tell you, you will correct yourself. That's quite okay. You should not make a mistake at the exam. I'm not taking anyone's name, but please give your answer.
Okay, we have answers for A and B.
Okay, let me make it very clear. Let me take you to that chart again. Can we go to that chart? It's here in this file only, na? Chart me, what I told you is, normally what we do, we see between 194Q and 206C1H, we see whether 194Q is attracted. If it's not attracted in the hands of 194Q, then we see seller. It's fine. On that basis, only 2-3 students have answered, but there is just one exception to it. It's a case of 206C1A. Where a manufacturer, in a case where 206C1 is attracted at the first instance, but of course the thing is exemption from TCS by virtue of 206C1A, where it's used for manufacture of process, producing articles or things or generation of electricity. By virtue of 206C1A, TCS under 206C1 is attracted, exempted. That's a separate case by itself. In that case, 206C1H is not attracted. If you see the chart I've given clearly, it's not attracted at all, irrespective of the turnover of the seller. If buyer's turnover is more than 10 crore and the value exceeds 50 lakhs, then 194Q is attracted, definitely attracted. But if buyer's turnover is less than 10 crore, 9 crore, in that case, the transaction does not attract TDS or TCS. It's a standalone case. In all other cases, you have to compare TDS and TCS, and then you see, not here, it goes under 206C1H. But in this particular case, where your exemption under 206C1A is available, there is no 206C1H, irrespective of the turnover of the buyer or the seller. Right? So the correct answer in this case, go back. Correct answer in this case is D. Neither Kishore and Sons is liable to collect tax, nor BAC is liable to deduct tax. Right, Dimple?
Yes. Actually, in 206C1H is applicable where the goods are not covered under section 206C1 and 1F. And in 206C1A, special exclusion is there if the buyer gives a declaration that it is used for manufacturing of article or things or generation of electricity and not for trading purpose. When special exclusion is there under section 206(1), that's why 206C1H would not be applicable in such case. because spatial exclusion is already given under section 206C(1)(a) in
And
respect
CBD
of that.
circular has clarified that this is not applicable. The same circular has clarified that 194Q has to be seen. So this is the case. In all other cases, you have to see 194Q first. If this is not satisfied, you have to see that first. But in this case, you have to see only 194Q. If 194Q is not attracted, then nothing will be attracted, because this is already exempt here. 194Q is not attracted. This is not applicable. 206C 1H is not applicable. I hope it's clear. Manoj, Abhishek, Uma. It's a standalone. This provision is a special provision only for items which are covered under 206C1 but exempted under 206C1A. In that case, you have to see applicability of only 194Q. If 194Q is not applicable, then there is no need to see 206C1H. This is only for this particular case. You listen to the lecture once again, na? Then fine, Abhishek has got it. Good. Now let's come to the other transaction. If Kishore and Sons required to collect tax in respect of sale transaction with XYZ Limited, if yes, what is the amount of tax? What is the sale transaction?
XYZ purchased coal of 55 lakh from Kishore
For trading purposes. Purchased coal. Coal is again covered under 206C1. Okay. So Kishore and Sons has to, and it's for trading purposes, it's not manufacturing purposes. So Kishore and Sons has to collect tax at source under section 206C1 on 55 lakhs, entire amount of 55 lakhs. What is the particular rate specified for coal? It's 1%. 1% of 55 lakh. 55 lakh into 1%.
So it's 55,000. So the correct answer is 8.
Because you have to first see whether it's an item covered under 206C1. Only if it's not covered under 206C1, then you have to see if specific provision is there for 206C1 that will prevail over 194Q or 206C1H. Because these are special provisions. 206C1, 1C, 1F, you have to see. If covered under these provisions will prevail over 194Q. If not covered under these provisions, then you have to see applicability of 194Q. If not 194Q, 206C1H. Afterwards, that's the order. But 206C1H, you need not see for items which are exempted by virtue of 206C1A, manufacturing. Items listed in 206C1, but which are specifically exempted by virtue of 206C1A. I hope it is very clear. Once again, otherwise, you watch the lecture once again. Any queries, you can post it in the BoS mobile app. Okay. So wishing you all the very best of luck. Whatever we could cover, we've gone much beyond the time. And thank you all for your very patient hearing. Those are you've been very patient. I know it must be exhausting because the portions are quite vast and we wanted to cover the things where you generally tend to go wrong. So wishing you all the best of the exam. I'm sure all of you will come out with flying colors. All the best.
All the best, all of you. And we hope that this session is very useful for you, and you have gained and you have learned something that common mistake which you will never do in the exam, and you will get the good marks in your exam.
Thank you.
Thank you.